Listen-only mode.
Hello everybody, good morning. Happy Saturday morning.
Hello traders.
Hopefully you guys can hear us. Welcome to, who says weekends are for resting? We're going to use the question box as usual, so you guys should all see, hopefully you're all seeing my screen. And there is a question box that you're, thank you. Okay, Don's saying good morning, so good to see you guys. And just go ahead and use that question box as usual. It'll be too much to use the chat window. So for the webinars, we just stay with the question box. And feel free, if we're hitting on something and you have a question, I'll see it and we can try and touch on it during. And if not, by all means, you guys please save all your questions, and we'll have a question and answer period at the end, and we'll make sure everything gets touched upon. So, short term, go ahead.
I just want to say, can you make me a panelist? I'm not seeing the question box right now.
Oh, I need to make you. You are a panelist, but I'll make you an organizer.
Organizer. There you go. So I can see the. There you go.
There you go. Okay, so. Day trading is primarily what our service has been focusing on up till now, but we've been wanting to do a webinar on swing trading for a lot of people who work or don't have the commitment or the ability or time to commit to day trading, but have an account that they'd like to try and make grow on the side. And this has been a really interesting environment the last few weeks, a few months actually, and so there's perfect timing really to have this seminar finally on swing trading. For those of you on our live service, for the last few months, Andy has been chronicling and documenting a lot of the trades he's been making in his SEP, self-employment retirement account. And a lot of people don't realize that they can actively trade, their retirement accounts or 401ks. There are some restrictions on them, like not being able to short or some other things we can touch on. So that's why we felt this would be a good topic to bring to you guys. So, let's get started here. Book recommendations. We always try and recommend a few books, and there is some crossover. We've recommended a couple of these same books in the past, but still feel that they're very relevant and very pertinent to swing trading and short-term trading. Reminiscence of a Stock Operator. If you haven't read that one, this one is by far our favorite book. It's timeless. It deals with the stock market 100 years ago, and you'll see that human emotion is the same, and it's not changed over the course of a century. And there's a lot of lessons to be learned, much more so on the swing trading than day trading, because there's a lot more of a time element here with this book and Jesse Livermore. We will be quoting a lot of Jesse Livermore quotes through the webinar, so if you see the word Livermore, you'll know that it came from this book. And that's always been our top recommended book ever since we read it back in 1998. Oops, actually got these mixed up here. I just realized that Candlestick is this book here, and let's get my pointer going. Candlestick trading is much more relevant on the daily charts than it is on the intraday. We use them for intradays as well for our day trading, but they really are designed to be a daily chart phenomenon, and that's primarily what we're going to look at today, are just daily charts because of the time frame that we're exploring. So certainly recommend you guys pick up Japanese candlestick charting, and again, it's much more relevant to swing trading. I feel there's a lot of good information. And then, of course, Trading in the Zone, dealing with the psychological aspect. Very, very good book written by Mark Douglas, and some great ideas and strategies in there. If you're not trading live money, it doesn't make a whole lot of sense, but once you've traded some live money and gone through the emotions, this book starts to make a lot more sense. So, for those of you that have read these books already, we just we can't emphasize enough for the people who haven't how much we recommend these three books. So, day trading, we know what that is, but what is short-term trading, or swing trading as some people call it? And, it can really be anything from a few days, and we'll show some examples of a few charts that you could make a lot of money in just 2 or 3 days, maybe a few weeks, or even a few months. And we have a couple of active trades on right now that may turn into a trade that goes on for a month or longer. And we'll show you some of those as well. Any other thoughts on that slide, Andy?
No, you pretty much hit it.
So here's the first slide to look at, and maybe try and again, I'm going to preface this. Andy has a lot more active experience right now in swing trading his account. He's been much more of an active swing trader than I have been. So I'm going to defer a lot of the insights on the charts to him. So starting with this chart, I'm going to have him kind of break down, the different time frames in which to look at a long-term daily chart here of the spiders.
Yeah, when we talk about holding a trade for a few days, a few weeks, or maybe even a month, you want to look what the overall market is doing. And I'm just going to kind of hit on this quickly because I really don't have the pointer and all that so I can show you. But Steve's kind of showing you there with the little dot. When you have an area like that where the market's not doing anything, but it's kind of just going sideways, chopping back and forth, you may be looking to just get into a trade, scalp it out, do a little swing scalping, we say sometimes, where you enter a position, you hold it for a few days, and take your profits. Also in a bear market, you have to use your, tight stops. You don't want to let losses run against you, so, you may be getting stopped out a lot, quickly. But, you see that bottom down there in March, fortunately I was able to position myself in my short-term account, and I'm still holding some of those positions as we speak, and had a nice little run, so I'm letting the market kind of dictate, the longevity of my trades. Now, I've been taking profits as we kind of go up. You have to ring the bell sometimes. We'll talk more about scaling in and scaling out, but so let the market kind of dictate. That's one of the things that's going to dictate how long you stay into a trade, but you also want to have target objectives, and we'll go more into that, but the point being is you really want to let the market kind of dictate how long you're going to be in a trade.
Yeah, trade the market first. We say that all the time in the day trading time frame. What's the market doing? And when we first put this chart up, what we were thinking is this is giving us a snapshot of three different market environments. And Andy said back here, when the market's not showing a whole lot, maybe your swing trades, you shouldn't be expecting too much, maybe keeping it tight and going for quicker hits. But all of a sudden, we've got this moving average, our momentum line, we call it, has dominated the price. And back in January, February, and early March, the bears were in control. And so you had a dynamic of the market that you probably are not looking for long trade, breakout trades to the long side, because the market environment is just really under pressure. Well, then we had that early dip in March, and for those of you that have been trading the last 8 weeks, you know that the shorts have just been getting absolutely run over. So this third market segment here is a complete shift in dynamics. Basically what was working back here is no longer working here. So the point of this slide, guys, is what is the major overall market current? Are we going sideways? Are we flowing south? Or are we pushing up? And a lot of your directional trades, should be based on those. Now we are going to look at a lot of pretty much mostly long side trades today, because that's what the market's been giving us as of late. And we try and keep these webinars with current information, so it makes a lot of sense. So we don't have a whole lot of short setups. Now that's not to say that a lot of these applications we're going to learn can't be applied to the short side as well. But for the sake of current examples, we're in this third stage here of a bull market, and shorts are not working. So we've been looking for long setups, and that's why this webinar is going to be showing a lot of long setups today. Okay, so there's time frames. What's the general market doing? And that should be affecting your micro analysis. Again, this was something back in Day Trading 101, but it still is very important, no matter what time frame you're trading on, is the characteristics of a good trader. And number one is patience, and patience is certainly a virtue when trading, no matter what time frame it is, and that has to do with sticking to the plan. Paper trading is easy. A lot of people have great success paper trading, but once you put money in there, you start to really get tested mentally as to getting out of trades too soon and things like that. Taking profits too early is a real natural tendency and an impulse, and we're going to talk more about that later. Being observant, of course, the market is constantly changing. As I just showed you, we had 3 different stages there on that spiders chart. Being observant of what's going on in the general market and the general tone, and being able to adapt early to changes is also very important on a day trading level and also a swing trading level. you need to be able to recognize some of these subtle changes, and we'll talk about some of these things graphically. Unemotional, that goes without speaking, of course. Trying to remain cool under pressure, and we'll talk about getting shaken out and how to avoid not getting shaken out on a daily time frame versus a different strategy for day trading. You're going to keep it a lot more tight as a day trader, but we're going to show you how to try and avoid being wiggled out and shaken out on the daily time frame, and that takes a little bit of a different discipline. So again, being unemotional and not losing your cool is important there as well. And being committed. Chance favors a prepared mind. Luck seems to find people who work hard. And in this business, it's just a matter of staying on top of charts and staying in the flow of a jump rope and keeping an eye on that jump rope. If you're leaving the market for 3 or 4 weeks and then coming back and making trades because you haven't really been watching, you got to be careful of that. You want to try and stay committed and treat this as a serious business. And being self-aware, we're going to talk about that as well. There's many different ways. Some people say a journal is important. I started doing YouTube videos a year and a half ago, almost as a way for me to just kind of look at my trades and from a different perspective, and it's kind of mushroomed into something else. And Andy has every day. He's got people watching him, and he's having to be accountable. So. It's an interesting dynamic that he goes through every day, and that's something that I often tell people as well. Trade as if you have an audience and you're talking about what you want to do, and you're staying true to your course and true to your plan. Anything? I'm probably not touching on a few things here, Andy. I'm sure you want to jump.
No, you're hitting it pretty good. I will add reemphasize, I should say, that you really have to be committed. I see so many people come in to want to put money in the stock market and have it work for them, but they just don't want to take the time. They're mentally lazy. You really have to apply yourself, and you have to want to learn, and because it's a serious game, and so you really want to dedicate yourself to improving your bottom line, and what it takes time. It takes the willingness to go out and put in the hard work.
Learn the sectors.
And another one. Go ahead.
Learn the sectors. Learn who the players are. A lot of people say, "Well, how did you know to go to that?" Well, it's 12 years of thousands of hours of screen time. Like a pilot has thousands of hours of piloting time. Both of us have thousands of hours of staring at a screen, and after a while, you just start to identify things. Kind of lost my train of thought there.
No, that's right.
Let me get a sip of coffee here.
I'll talk more about that. I mean, he's not saying that you guys need the same amount of hours that we do. Because
no.
We're talking more of our day trading. But we're going to give you some tools, and some real easy tools, and some strategies that you can look at. What you want to do is, apply yourself. Keep on top of the game. Don't just buy these things or buy a stock and just turn around, forget about it for 3 weeks, come back and see it's down, down on you 5 points or something like that. So you just want to take the time and the dedication it takes. Go ahead.
This stands for always be learning. Every day we're continually learning. And what I was meaning to say is, find out who are the players. Get a program. Who are the major stocks in each sector. And I think it's very important for you to learn as quickly as possible the different stocks, what sectors they are. Are they leadership stocks? Are they second-tier stocks? And just get familiar with the other players, because eventually that sector is going to heat up, and you're going to want to know who the players are. Okay, and again, we're going to go over examples. We're just kind of setting all this up here. Here is where a lot of difference comes in, day trading versus swing trading, in the way in which you tune in or tune out the news and the noise of CNBC, analysts, upgrades, downgrades, sentiment, what have you. And we're gonna talk about a few things here. And I think I'm going to actually let Andy kind of go through this one here, because we've got it all laid out, and he's probably got some good analysis on each one of these.
Well, I'll just kind of briefly go over each topic here. The main point we're trying to make here, and we'll go over more of this, is watch what the price action is telling you. Okay, you hear news out there every day. You hear analysts, talking heads, getting on CNBC, telling you where they think the stock's going to go, and commentators as Kramer, and but guys, you have to take all that with a grain of salt, because the price action, people lie, and stocks don't. Price action doesn't. So when it comes to earnings reports, commentators, I will listen to it, but I don't put a whole lot of homework or emphasis on it, because I think a stock's price action can tell me a lot more than what those guys are telling me. And you're going to be following the herd if you're just listening to the news and making assumptions based on news and commentators, and you don't want to do that. You want to let the movement of the stock, be your guide. And we'll go into more each one of these, and that's another one. That point there is don't trade news based on your predictions, and that's exactly what I'm talking about. If you listen to these guys, you'll start making predictions in your heads, and you'll start reacting on those predictions, and you don't want to do that. Let's see, and the rest of them I think we're going to cover pretty much in this webinar, so we could probably we hit the gist of it there.
Okay. I'm sorry, I was just sending an email to two people who are trying to get in. Perfect. Okay. So we're ready to go here. Let me erase this. And yeah, again, we're going to have examples of all this. Okay, so here's another chart, and I'll let Andy kind of dictate where I'm going to direct your guys' attention here.
Yes, this is an example of a stock that had earnings report right where I placed the crosshairs there, right around, you can see the gap down right around the 10 level there. I was actually long this stock from earlier in the month, pretty much right at 10. I sold a little bit going into earnings, took some profits.
And again, earnings were right here, correct?
Right, the day after that day. Yep.
Okay.
Okay. Well, the earnings came out, and they were just horrible. I mean, there was nothing good in that earnings report. And you could see the gap down the next day. But my observation is the stock market had had a huge move since March, and this stock has done nothing. Okay? So even though the earnings report was really bad, I'm thinking, well, I think there's a lot of people short this thing. This is my observation because the stock hasn't moved. Whether it be short covering or whether it be just the fact that, hey, there's been a huge move, the market's up 35% and this thing's done nothing.
Right.
So I held on.
Sorry.
So go ahead. I held on the next day.
I was just going to say the market had been moving higher, but the stock had not. Okay, so relative to the market, it had been held down.
Right. Exactly. So. So in other words, yeah, I heard all these earnings reports, heard the commentators, everything was just terrible about it. Well, it gaps down the next day and pretty much closes where it opens. Yeah, it finished down on the day, but it never went lower. So I held on to my position, and now you see the next day after that, we have follow through. It's going higher, and I actually sold the last of mine on that yesterday, actually. I can't remember. Is it the close? I think it may have been the close of Thursday, but the point being is, guys, a lot of people who are in the stock, immediately after that earnings, they just hit the sell button.
Panicked.
Panicked out just based on the earnings. And the point I'm trying to make is, don't do that. Don't listen to the earnings. I mean, I'm not saying don't listen to the earnings. I mean, fundamentals are important, but at the same time, let the price action dictate, your executions.
We've got a question here from Nick. How about the news about dry ships? They said that it will dilute shares. Let's hang on to that, Nick, because a lot of these questions are going to be good. We're going to look at some live charts at the end. So hang on to that one, and then that way when we get to the slideshow, we can actually bring up that chart, and it's a good one to talk about.
Sure.
Okay. So next slide here. Another example.
Yes, this is ON Semiconductor. This is just the opposite. Okay, they came out at the top of that last red bar there, right there.
Mm-hmm.
This is the day after earnings. Well, they had incredible earnings. I mean, it was just a beautiful report, and gapped way up, and I can see, I can just picture everybody saying, "Oh man, this is great, man! I'm buying this company." And look at that, it gaps up, and then just gets hammered all day long. Puts in an ugly dark cloud cover over the following the day, which is a kind of a negative chart pattern. But the point being is they had a great earnings report, but it had a nice little move going into earnings. So
it had
read
run
the report,
100%. Yeah.
Yeah.
it had run 100% into earnings. So a lot of times, this is a great buy the rumor, sell the news, case. The people, that were buying this thing into earnings were slowly profiting on the way. And then as soon as the earnings came out, you got the gap up, and the price action immediately told you, if you look back, whoa, we've already moved almost 100% here. The point being is, pay attention to the price action. And on that last chart, excuse me, HIG did not go anywhere. So it had been lagging, whereas this chart had already been participating. So once the news came out, it was pretty much a buy the rumor, sell the news fact. You got to be careful about that.
That's right.
Any other thoughts on that chart?
No, just see where a stock has come from. Look at the green bars. Look at the green bars going up into the last remaining week there.
Yeah, people buying into earnings.
Buying into it. Having a good insiders, whoever it is. Well, those are the same guys who are selling the day after earnings when everybody else is trying to come in and buy. So it's not always the case. I'm not saying every good earnings report is going to gap up, and then fill the gap. That's not always the case. But the point is, don't assume anything based on the news and the earnings report.
Yeah, and again, that's a good spot to stop. And because people in our service have heard us talk about this day after day, it really doesn't matter how you interpret the news as a trader. You have to pay attention to the price action, and that's been the point of these last two charts. Two examples. One had a pretty good run into earnings and sold off. The other one did not participate, but had good earnings and still bounced up. So, just paying attention to price action. Okay. Erase that. One of the things that we try to do is keep things simple across the board in our approach and our methods. And when you really think about it and get down to it, we're essentially applying many of the strategies that we use in our day trading methods to short term. And what I mean by that are some examples of you can apply your entries. Same methods, same mentality, same emotions and psychology, and even technical levels go into your entry. And you guys know from our day trading service how important we preach the entry is. Giving you a good, solid entry can really make the difference in the world on how the trade plays out. And then, of course, the technicals of moving averages, a momentum play, and we're going to show some examples here. And, of course, volume. If people always ask us what's our favorite indicator, well, it's going to be volume. I think that is the most telling of all the indicators of what's really going on behind the scenes. And then, of course, wicks. You guys hear me a lot talk about wicks, and more so on the daily chart are, in my opinion, the pattern of a wick or the appearance of a wick really gets my attention on a lot of these daily charts, and I'll be showing you why here coming up. And the same with support and resistance. So all these things are very similar to day trading and can be applied. You're just looking at a different time frame on a daily chart, and quite honestly, daily charts have a lot more to tell than intraday charts because of the way they open, the body of the candles, and where they close. And we're going to talk about how important where a candle closes, much more so on a 5-minute chart. So those that have been following along, Andy had a pretty monster call a week and a half, 2 weeks ago in the UNG, which is the natural gas ETF, and he's still long, and we're going to kind of break this trade down a little bit. There's been a lot of questions about it, and so going with the same theme that we just talked about in the last slide, applying the same tactics on an intraday day trading scale can be done on a daily chart. So I'll let Andy talk about that.
Yes, I believe I'll go more into detail when we talk about volume coming up here in the next couple of slides. But I just want to talk briefly here about, we talk about using technical indicators, moving averages, volume, stochastics, but none greater than volume. I mean, going back to stock price doesn't lie. Well, volume is by far the biggest truth teller out there, man. And if you look at this UNG, what I started noticing, and once again, I'm going to quickly hit on it right now because we're going to go into more detail on it in a couple of slides here, but where I show you the weekly chart on it. But this is one, that I picked off the volume there at the end of April, and just noticing the huge amount of volume coming into it, and You know, you'll hear a lot of people out there say do not bottom fish. I'm not one of those guys, because I think if you apply your disciplines and use scaling in approaches, you can pick bottoms, and you just have to be. I actually tried this stock back in my long-term account back around 20. There's some guys on our service, I think they were, it failed. It failed, but I used my disciplines.
Where was
I got
that?
out.
Let's talk about
right
that.
there.
Right there?
Right
okay,
there.
you bought it trying to break out through 20?
You know what? I think what it was, Steve, it was back around the 1st of February. It was actually below 20.
Okay.
Right there, and looked like it was.
So you were
turning
seeing
around.
some basing there.
Yep.
Okay.
Mm-hmm.
And you probably
Looked
saw
like
a
it
little
was-
bit of volume here.
Yep.
Okay.
Yep. Looked like it was basing. It didn't work out. It failed, and I got out on that first gap down there.
Right here.
Yep. And for a small loss. Okay, so I entered 1/3 of my position. Didn't work out. I exited the trade. So very, very minimum loss there. But, you know, I came back to it 3 months later, and now, you know, I
Much
accumulated
different volume story.
Yeah. Yes, exactly. And once again, we're gonna go into this
Chart.
in a couple of slides here. Yeah, we'll talk more about it when we talk about volume.
So again, the purpose of this slide was to translate daily, intraday, and intraday strategies into the daily strategies. So did we
Yes.
cover that?
Yeah, yeah. This is the case where we're using volume, you know, as a technical indicator.
Okay. And I think on this one we're kind of highlighting the same thing on an intraday chart. You guys see us a lot looking at a 5-minute chart, making sure stock continues to ride the momentum line and using that as our guide. Well, once again, same thing on the daily chart. And here's where I really want to draw attention to. It's so important. You know, during the middle of the day, at one point this thing was broken down, but it was midday, and we're going to talk about doing everything we can to try and let these candles finish themselves out. Many times they will flirt and then bounce back up and close. So the point being is, on these daily charts, using this moving average line, which is different than an intraday, but very important, is where did the price close? And you can see a few times here, there, and here, and here. You know, it kind of tested the resolve of the trader, and even to a certain extent here. But for the most part, it still maintained a close above that momentum line, and that's a very important point. I want to see where these candles close. I'm not concerned about making split reactionary decisions in the middle of the day just because this thing broke down. We have to remember that we're on a daily time frame now. We're not zoomed in on an intraday 5-minute, so we can't let ourselves get spooked out, and we're going to talk more about how not to get wiggled out. But very important point that I'm trying to make is try and let these candles close out the day and see where they close before you make your decisions as a swing trader.
Right. And I want to add to that. We're just using the 10-period moving average here, guys, as a kind of momentum play. We're not saying you need to use this line when it comes to swing trading or short-term trading, because if you do that, you're going to get stopped out a lot. This is just an average. I mean, this is just an example of using the momentum line, what we call it. That's a line that we use a lot in our day trading. There's several things you can use for exit strategies, when to take profits, and this is just one of them if you're playing momentum.
Yep. Next slide. Okay. Let's see. This is Palm, and go ahead and this was a trade that you.
Yeah.
Go ahead.
You know what? This is the trade that I wished I'd made in my long-term account. I actually bought this. I scalped it out on that first day in my day trading account, that first big green bar right there.
Where'd you sell it?
I sold it at the close of the day, and that was a big mistake.
We're going to talk about that. Yep.
Because, well, the big mistake was not buying it in my swing trade. A lot of times, and you'll see examples coming up, where I'll use my intraday chart setups and volume setups to actually take a position in my long-term account. I do that quite often, and a lot of times those end up paying off good for me. This is one that I missed, and I'm still regretting it. But this is one where this was actually news that came out. That the only reason that bar right there didn't have a bigger volume bar, this came out like with only a half hour left in the trading day. But you can see the next day, big gap up, huge green bar. But that's very similar. I think I pointed this out in our service. It was very similar to the action I saw in Apple several years ago when it was trading at $7. and you had volume like that for like 3 days in a row. And well, when you see something like that, you know something's coming around the corner. And sure enough, a few weeks later, iPod was introduced, and it hasn't looked back since.
Let's assume that maybe we didn't even well, we know what the news is, and it's always good to know what the news is. But I want to kind of give you guys a setup here that I think hopefully is worth at least the price of this webinar alone. We're going to show some more examples of it. And that is, if you're in the swing trading mentality and you're going to take a stock home, I think 99% of the time, and Andy said he was kicking himself because he knows he should have. And here's the dynamics of what's going on here. Look at this volume bar. Obviously a huge story, and there was a story on that stock today. Cannot disregard that. When you correlate a volume bar like that and a candlestick that closes on highs, you have to take this home every time. Every time. Steve, you have to take that home. Yeah, go ahead.
I have to interrupt here because that's the next day volume bar. Remember, I just said that. But good point there. Remember that first big green bar? Yeah, there you go. That was
okay.
The news was released with only about 30 minutes left in the trading day.
So
but still good volume.
It's still good volume, and like Andy said, had more time to trade, it would have done bigger volume. But I want to go through the actual dynamic of what's happening here and why this is such a good trade to take home every night. If you find yourself in a stock that you're long and you're thinking about taking home, and some news or volume or whatever kicks into it, and you find that at the close of the day you're on the high end of a beautiful candle with pretty good volume, the dynamic is such that you're early to the party. Just recognize that you are early to the party and you have something that somebody else wants. So when the market closes and the Wall Street Journal report comes out and this news comes on and people that missed it see themselves missing it, they want in, and they're going to have to pay up. And it's almost a guarantee. I shouldn't say guarantee, but I will take this trade 99% of the time. And we'll show you a few of them that might work a little bit too. But it's important to recognize this overnight space here is such a good take home, because these people that want in, and don't forget the people who were short that got stubborn and didn't get out, or maybe got trapped and weren't even aware of the news and didn't have a stop to protect their short, all those people have to pay up the next day because of greed and fear. They're going to have to pay up. And that is when you really want to take a stock home. Big volume, in this case, pretty good volume on the close. Closing on the high of the day on a big candle. Many times you're going to have a synapse here. The very next day, your people are going to have to pay up. And then, that being said, many times we do like to take profits, at least half profits, because those overnight trades, in this case, there was nice follow-through. It was kind of a different story, but we'll show you some other cases where selling the gap on the next day proved to be a pretty good deal. So, point of this slide, just want to drive it home. When you see a setup like this, and we're in a go ahead.
Oh no, I just wanted to say a little bit off the volume topic, but I wanted to point this out. Yeah, Steve actually had a good call on this about 4 days before, when the stock had pulled back and was riding that momentum line. In our, you mentioned that in our live service, and yeah, I kicked myself for not taking it right there too. Just had a nice little run up. You had 3 green bars, and it just had pulled back, was consolidating right along that fast line there.
Yeah, what I say a lot of times is it forces the issue. If you see a stock have a nice couple of good bars and don't really pull back, just kind of throw in a few dojis and kind of go sideways, it's essentially kind of just waiting for a reason to pop back up. And in this case, our fast line provided good support. But again, if you guys find yourself in a trade like this, consider taking it home and then selling it on the gap up the next day. Because the idea is you've got something that other people want, and if you sell too early, you might be selling yourself out too soon. Okay, so we're going to talk some more about volume, I guess, on this UNG chart, Andy.
Yeah. This is at that UNG again, and guys, just what I wanted to show you here. If you look at those green bars, and if you go back to like March 16th, where you had that pop up on the green bar there, and looked good, but you had no continuation after that. You had a little bit, but then you had. You see what I'm talking about, Steve? This little March 16th area.
Hang on a second. March 16th, right there.
Yeah.
Okay.
Yeah, you had a volume bar there, but it went right up to its 50 period there, and you had a little bit increase in volume as it came in, but it never could get above that 50, and then you get covered up with these 2 big red bars coming back down. volume bars coming back down. So, yeah.
Denied.
Yeah, that's a case where you could have
Denial.
taken a position. Yeah, exactly. You could have taken a position there off that green bar. I mean, it looked like it was turning around, popped above its moving averages, but once again, it failed. And once it breaks down below that 15, you have to get out. But this case where I entered, and I wish I had a weekly chart up there. I thought I did, but that's okay.
Yeah, I thought we did
go
too.
back,
I'm sorry.
yeah, that's all right. But what I saw on the weekly chart was.
We'll do it at the end. We'll go back to the
Okay,
end.
yeah. I'll show you guys. Yeah, on my. I did a weekly chart on this, and it would probably be around April 28th or something like that. But it finished with a big green bar, volume bar on the week, and it closed at the high of that bar. And I'll show you, comparing that to another green bar you saw about 3 or 4 months earlier, where it had a big green bar, but it had a big, what we call a shooting star, where you had a big old wick and it closing at the bottom of that channel. But the point I'm making here, guys, is driving home is volume, volume, volume. I saw volume coming in. You had consistent volume, and then on that third, going to the 1st of March there, that's when I knew. I think I was pretty comfortable that I was in a really good trade.
1st of May? Do you mean the 1st of May?
Yeah, 1st of May, where you had that big green volume bar right there. Okay, I bought this at 13.20, going back to like April 28th or something like that. I bought it at 13.20. Then I saw that big green volume bar right there. The next day, sold off a little bit on less volume. I added more at 14, I believe 14.10.
Let me do this, because actually Nick had a question here. I'm sorry, John had a question. What triggered you to scale in? It might be is this the right chart to talk about that?
This is a great,
Okay.
yeah, anytime you're trying to pick a bottom, you have to scale in.
Let's talk
And
about
if
where
you're wrong,
your
have to
first
get out
purchase.
quick.
Mm-hmm. Okay, so where was your first purchase? It was right around 13, I
Right there.
think.
No, 13.20.
Because
no,
what you
the
know.
day before.
Okay.
Because that's when I really noticed the volume.
Okay, and not only that, I'm sorry, but it also failed to take out that prior low.
Mm-hmm.
Okay,
That's right.
so price action failed, retested the low and failed to take out the low, but a big surge in volume started to come in here as it held that double bottom. And in hindsight, it was a double bottom. So go ahead.
Mm-hmm. And it was risky, and I know it was risky, and that's when I don't take my full position. I scale in. I took 1/3 of my position there. Okay.
Remember going back to here.
Yep. Exactly.
The first time he scaled in, 1/3 position, he was wrong, got out. So it only hurt 1/3.
Exactly.
So same thing down here, trying it a second time, better volume, and this time it worked.
Yeah, and on that third green bar right there, I felt real comfortable that, hey, I got to have a good trade here. This, and a lot of things I'm looking at the rebound in oil and just commodities, and I know this thing has just been killed over the last year and a half. That's not a good reason to be jumping in a stock, to mind you, just because it's been killed. But at the same time,
technicals,
it's a volume. It's a volume, and then on my pullback, I bought another third right there at 14.10. So now I have a good position. Mm-hmm.
So what happened was, I'm just sorry, he was using those moving averages. It was a very tight range that day. I'm going to erase this so you can see that. But you can see a very tight range, and it didn't fall back at all. It still closed and held above those moving averages. So I think that's when you decided to get the next one.
Right. And now I have really good volume coming in. You got look at these last two bars, just incredible volume coming in this thing. So I'm not looking to sell. I noticed a lot of people on StockTwits were taking their profits early on Friday, and somebody, I think Steve mentioned to me, you want to peel a little bit off, and I said no. I said, man, you catch a falling knife like that, man, you got to go for a bigger move, and you can't just scalp that one out. So I'm actually looking for a pullback, possibly to that 15 level, and maybe
to buy more.
To buy more.
Okay, another good question quickly from Ed. How tight was the stop on your first position? Well, I'm going to say more than likely it was you draw a line here at that double low, and if it dipped back below that double low, you're probably looking to get out within 20 cents or so.
I think he was talking about back in February. Back in
okay, how
January,
tight was your stop on the first position? Okay. You want to clarify that, Ed? Because I think it's a good question. Are you talking about this second attempt or the first attempt around the 20 area? Okay. I was right. Okay, so we're talking about his current position. So down here, noticing couldn't take out the double bottom, big increase in volume. I would say, Andy, your stop would have been where?
On a case like this, definitely I would be looking at a lot of things. One of them would be volume. If it pulled down and just barely took out that low, we'll talk more about wiggle room and avoiding shakeouts. But just having a third of my position, I probably would have given this thing maybe I'm going to say probably a dollar, dollar and a half. I wouldn't want to take out. If it took out that low going back over there, I'd be watching it very closely just to make sure. You could have one little shakeout, put in a wick, and bounce back up on volume. The volume would probably keep me in it a little bit longer than normal because I knew there was volume coming into it. So if it pulled back and went and tried to wick me out through that low but did it on less volume, I would probably give myself a couple of bucks on that one.
And again, we're going to show some more charts that's really important to try and stay in the game and not get wiggled out because the market is designed to try and shake people out all the time. And so on the time frame of swing trading and short-term trading, you've got to be a lot more liberal and loose with your stops. And like I said earlier, paying attention to where the market is closing. Not so much the intraday price, but where's the closing price. And quickly, I think Nick mentioned earlier, so if it's 10 period moving average, you get out. I think I understand what you're saying. Let's go back to that first attempt that Andy had here at 20. And you see a big red bar there. Well, it closed pretty much right on the line, hugged the line again here, but then look, it starts to close. It starts to close. Once it starts closing behind that 10 period, it was over. It just started bleeding again. So that's why I feel where the closing price is very important to try not, and like Andy just said, he's watching it very closely intraday to make sure he's not getting wiggled out. It's a different mentality than day trading, trying to not get shaken out of these swing trades. All right, so. And again, we're still talking about applying day trading techniques to swing trading charts to keep it simple. So on this slide, Andy put together, we're going to look at support and resistance, just like a 5-minute chart will show. So will a daily chart. Your thoughts on this one?
Where I have the crosshairs right there. You had a big line of resistance right there going back. This is the XLF.
That would be support there as it's supporting the price.
Well, no, as it's going up, that's resistance. Oh, you're talking about?
I'm talking about right here. I'm sorry. Am I on a different page?
I'm looking at more. Yeah, well, I'm saying going back to that level, that's resistance now. No.
Well, yeah, prior support. We always say prior support becomes current resistance.
That's right.
So a 5-minute chart, we look at the same thing sometimes on a 5-minute chart. Let's maybe pretend for a moment this is a 5-minute chart. And it's a stock we're thinking about shorting. Well, look, 20 held before, and it's coming back up to that level. We're watching it real closely here. A couple of wicks there, and it failed. Just like a 5-minute chart, on the daily, intraday, excuse me. Same kind of price behavior, prior support, current resistance. The same thing shows up on a 5-minute chart than it does on a daily chart, and that's really the point of this slide.
Now, it did end up finally blasting through that, and, that's when you probably had a lot of shorts covering, once it finally got above that level right there.
Yeah, this chart's a few days old. That's true. And talking about some more, that's my Tiger Woods chart. Watch this. Ball comes in, spins back. Okay. Using support and resistance line again, so we have another example here, and you can see real easily here that the 10 period. I'm sorry, the 20 level. Once again, same number, different chart, different company, but round number of 20 was support resistance back here. Whipped through, couldn't close, came back, retested it. Prior resistance becomes current support. If you're looking at price and trend lines and support and resistance lines, this could have been an interesting entry. Looking at the volume, let's see, was there anything? Well, look at that. That was kind of a suspect move up on lighter volume. That would have kind of scared me. But again, going back here, here's the 20 again, breaks through, comes back, and then tests it. So you can call that a pivot line. It just kind of snakes back and forth, becomes resistance, then it becomes support. Hopefully that's clear for a lot of people to see.
Yeah. And actually, I didn't take it at the time, but I remember calling it on the service when I had that 3-day sell-off right where the crosshairs is. That was probably a pretty good pickup there at the 20 level. Yeah, give yourself, because once again, the prior resistance now becomes support. It held it again, and give yourself an easy stop. If you buy it there, it breaks down to below that 20. Give yourself a little wiggle room to get out. Don't argue with it.
And, I can't recall at the top of my head this type of pattern here, but you read that candlestick charting, and that's a nice daily. You have a red candle trading down with the whole body, and then you have a green candle trading back up and pretty much reversing that prior day. That's a very, they call that like a reversal, short-term reversal signal. Couple of quick questions just to catch up. Are you using the same moving averages as day trading? Yes, that's correct.
Yes.
Simple moving averages, and on a daily chart, John, it just becomes it calls a DMA, daily moving average, and you can quantify those as simple or exponential. Some people use exponential, but we just always keep it simple, so we use simple. Does volume tell you anything about, that's a good question, Miss Andy. Does volume tell you anything about support and resistance?
You know what? Yeah, it will, especially if it breaks those areas with volume. And yeah, I would definitely I'm always looking at volume. I mean, that by far is our biggest technical indicator. It's the most important technical indicator. The volume trumps everything. And so if you see volume associated with a support and resistant areas, yeah, that's even a double conviction for me. But I don't think you don't have to have volume, to play off the support and resistance line.
In other words, moving through an upside resistance area, if you're long, you're going to want to see a lot of volume associated with that, knowing that it's actually taking out that pivot level on volume with conviction. So just substitute the word conviction with volume.
Yep.
All right, let me erase these and see what we got next. Okay, again, we're still talking about applying intraday 5-minute charting. We're still looking at the same kind of a thing, just using a daily chart here. And we've gone over volume, we've gone over moving averages, support and resistance. So now we can show an example of how a trend line can also work for you in your advantage. Go ahead.
Yeah. Trend lines actually come into play a lot more on the daily than they do in the intraday charts. You definitely want to be aware of how a stock is trending. And when you get a nice defined trend line like this XHB going back to March, those are really good entry spots to take a chance on a trade. It pulls back to that. You can see there at the end of March, it pulled back to that trend line and then just wicked right back up right off that trend line. And so you definitely want to, if you have tools, hopefully if you have tools where you can draw these trend lines, because you always hear, I'm sure everyone has heard, trend is your friend. Well, this is a very well-defined trend line right here. And trend lines are a big component of my swing trading and short-term trading.
And just, as I'm looking at this chart, we can actually apply the last slide to it. We've got a pivot level here basically of 12. Look at that wick at 12. Couldn't close above 12 with a wick above. And then we had kind of some cup and handle action going here at 12. And then, as we just talked about with volume, look at the volume, confirm that this thing actually did want to have a nice move through 12 based on that volume there. Okay. Hang on a second here.
But guys, this is how I want to point this out. We talked about this on our intraday trading. We keep it simple. I mean, so many other people, they use all this RSI, MACD, convergence, and, we talk about over-analysis paralysis, and I think sometimes people try to make this too much of a science, and we try to keep it simple. I don't think you don't need all these tools. And these are very simple indicators that anybody can apply, and there's so many more indicators you can use out there. But I think it's overkill. I really do. That's just my personal opinion. I don't use them in my day trading or my long-term trading, and I've been very, very profitable without them. So,
Jerry wants to know what software we use to find our stock. To trade. Well, the main tool we use is called Trade Ideas. If you're not familiar with that, Jerry, you can email me and I can send you some more information on that. It can be used both intraday, and you can also have some configurations on there to maybe alert you on the daily stuff, like stock trading above 200-day moving average or things like that. But again, it's very important to go back and know who the players are, know who the sectors are, and who the players in each sector are. Because if you kind of start from the top down, we're in a nice 8-week little bull run here. If you're paying attention to what stocks are doing well, obviously the financials have just been the place to be lately, and so we've been focusing a lot on the banks. And so just knowing who the banks are, the big players, the second-tier players, the regional banks is really what we've been focusing on a lot lately, Jerry, because that's really just kind of what's been in play. So start from the top down. You know, are we in a bear market, short-term bull market? Who's winning the battle, and what sectors are performing well within this environment, and kind of key off of those as well. But in addition, we do use the Trade Ideas as a software that you asked about. In a second, I'm trying to get my trying to expand my question box here so I can see the full questions.
Okay, I'll answer John's question here while you're doing that.
Yeah, I'm trying to. Thanks.
He asked, what is more important, the 10-period moving average or the trend line? I would have to say, well, that's a tough one. You know, if I'm in momentum trading in my day trading account, I would definitely go with the 10-period moving average. But you know, and that's, you know, these are technical indicators, and you have to use them, you know, along with a lot of other things. And you know, in my day trading and my long-term trading, you know, gut feeling, just intuition, that kind of sometimes trumps all these indicators. And trend lines are important, but to say they're more important than the 10-period moving average, you know, that's just a matter of a personal, you know, opinion, I would think.
I think there's one way you could separate the two is sometimes you have a move that's basically a momentum move, and it's a nice quick move, and then other times you just have gosh, had a thought there and just kind of lost it.
Well, let me add to that. Okay, look at this XHB chart right here. And this is why I said, guys, you know, I do not want you to get thinking that everything has to close above the 10-period moving average, because we showed you a momentum chart of Google, and I just wanted to show you a nice momentum trade in a swing trade environment. But look at this XHB. Now it closed above several times below that 10-period moving average. That doesn't mean you get out of the trade. I mean, it has a nice trend going. So I mean, you want to use these technicals, but man, and we'll talk more about wiggle room and giving yourself a little. I mean, as long as the trade is working for you and you're profitable, you do not want to get you know, shaken out just because a 10-period moving average didn't hold. You know, because there's a lot of things, you know, when a stock's working for you, you know, look at everything. Look at volume, look at trend lines. You know, yeah, if it breaks down below a trend, or maybe if it breaks down below a moving average, you sell a little bit and let the rest of it work for you. You don't want to get too caught up in these technicals and make this a science in getting out of good trades just because, you know, a stock closed 3 cents below its fast line, you know.
There's a good question from Nick quickly on kind of relates to this. How do you know when a trend has reversed? Well, that trend line is very important to draw many times, and you know, if that trend line is broken and on big volume, sometimes you can see, you know, the beginnings of a profit-taking move. The key is being able to recognize when that trend line is broken. Now, in this case, it's very important, you know, really to pull back and start drawing some lines. And you can see that this particular home builder chart up here is struggling at the 14 level. It's having a hard time getting through it. So in this case, I would consider this trend line to be broke when that blue line that Andy has drawn is broken and closed below on big volume. Again, volume I think is the key, as we've said many times. So, you know, on this particular chart, it's struggling up here at 14, and I would consider this trend line to be broken when that blue line is breached and closed with decent volume. Now, this volume here is kind of alarming. You know, it's a pretty good red volume bar, and it closed back below 14, which it's really been very unable to do except for maybe once. So you can see the 200-day moving average has started to come into play here. A lot of wicks, a lot of supply for sale up here at 14. So if we come in Monday and I have a candle like this, it's closed on its low, just like the opposite of what we saw in that palm chart, closing on its high, and we got volume like this, then I'm starting to think this trend line is breaking. So All right. Good question, Ricardo. You probably heard me talking earlier on that palm chart where it closed on the high of the day on good volume, and you have something that the other people wanted to the long side, and so it was a good idea to hold it over. Just flip some of these charts upside down. It's the same, same mentality, same dynamic going on. And if you are short a stock, like I just showed, let me go back. Well, I erased that screen, but let me go back again. And let's say that you did catch a swing trade, and this particular stock closed down on its lows, just like that. So this candle closing on its nose, no wick. I don't want to see a wick. I want to see heavy selling and ending on its lows. I would take that stock home, and that's to answer your question. How do you know when to take home a short position? I would take home a position like that in the hopes that maybe the next day you're going to have some follow-through gapping down. Okay. Let me get back to the next screen here. You back, Andy?
I am.
Okay. Okay, we'll get over our stochastics setting. We can do that later when we get Andy's screen up, Ricardo. Okay, here we're going to talk about now some entry and exit strategies, how to marry up the intraday chart with the daily chart, and a lot of times we will use the intraday chart, the 5-minute time frame, to time our entries, and then once we're in it, we're using the daily chart as a guide until we decide to exit, in which time we will go back to the 5-minute chart to look for a level on the short term to exit. And what this screenshot is this is a trade we took, and we actually, this is a screenshot that was put out on Twitter to StockTwits. And sometimes we'll do this and we'll kind of explain what we were thinking. And so we'll just use this as an example here. Looking at the daily chart first, we saw that Ford got rejected up here around the 450 level and fell down, broke its moving averages on, not great volume, which is good because it was kind of a low volume pullback. That's what I would want to see on a pullback. I wouldn't want to see a lot of big volume. But here, pay attention to what happened here. During this snapshot was taken in the middle of the day, because you can still see we've got the morning trade going on here in the 5-minute chart. And at the moment, this is when I pulled up Ford and said, hey, look at this. We've had 1, 2, 3 really good days of selling, and we've got this wick, and it's trying to maybe dig in. If we can get this Ford to close above this 20 period, I think that's a pretty nice looking 1, okay, trend line. 2, we got this red 20 period. Wicked through. I love a wick on a daily chart. I'll talk a lot about that. It shows short-term reversals is another good answer to that question a moment ago. How do you know if there's a reversal? Well, a wick is another really good daily chart. The longer the wick, the better, in my opinion, it looks. And where did it close? Well, it wound up, fighting with this 20 period. So I said, Andy, this might be a good time to talk about looking into getting into a Ford swing trade. And so what we did was we put it on the radar, and then we shifted our attention here to the 5-minute. And look at what we noticed. Look at all this volume here intraday compared to what was going on the prior day. Okay, ton of volume. This is just like that UNG trade. Okay, this thing fell back and fell into a level where we could see on the daily we got a nice wick and nice trend line holding, trying to fight this 10 period. If we could get this stock to close above 350 or above this 20 period on this day, this might be a great entry. So, this is what I tweeted, focusing on the daily chart for a swing trade, a few good days of profit taking. This is what I was seeing here, a few good days of profit taking, and trying to stabilize at the daily 20 moving average. There's that red line right there, trying to stabilize, a wick through, touching the trend line, and trying to stabilize. Okay, decent volume today in Ford, maybe some accumulation. Well, I think that's what was really happening down there. You had some accumulation. You had some big institutions and fund managers saying, I love Ford at this level. And how do we know that? The volume. Volume does not lie. So this trade actually worked out to be a pretty good entry. And let me erase these and we'll go on and see how it worked out. But again, the focus of this slide was to show in real time how we were using both time frames to identify the trade and then use it for the entry. Oh, and just before we get away here, basically when it took out these highs is when we decided to get long. Is that correct, Andy? We got long at about 350, but actually it was about 345. We started anticipating it, watching it, and you see how these moving averages, let me clear that again, on the intraday here, these moving averages started to hold, started to push it up, a lot of volume behind it. And then as soon as it broke above 350, this became a really good trade. So here's the trade as it was snapshotted yesterday. Here's that entry we were looking at, and as it turned out, this day, before we look at that, closed pretty much just about near the top. The volume was increasing, so we had some good volume. And look at that. Once people realized that this thing was in gear, had a nice reversal on big volume, they had to pay up the next day. Now, in this case, obviously you could have got out of some, but we felt that this thing was going to be at least trying to get back to highs, so it might be worth at least holding on to. And I think as we got to highs, we did sell half, right?
Yeah.
And then the theory there is, this was a nice little 23% move right here. Who knows what was going to happen as it got to highs, so why not lock in a little bit of something here and do it at highs? And the theory being there is you're satisfying both emotions. You're satisfying greed, that you're going to take some money off the table, and you're satisfying fear that you're going to, lose out on a pullback the next day and miss taking profits when you had it. So we took half off the table there, and then as we got up close to 6 here, it couldn't get through 6, and I believe we sold out just under here, didn't we?
Yep, it sold out to about.
Okay.
I think I sold the last at like 580 or something like that. I can't remember the exact number, but it was a huge move. It was one of those cases where it's a nice little momentum trade there, but when you'll see other charts, a prime example. Sometimes, guys, when I get a huge move like that, I just ring the bell. You can miss out. This thing may go to it got above 6 there, but then it pulled back hard on Friday. But I had a huge profit in that, so I rung the bell. Steve kind of forced me.
Let's talk about this day, though, because look at this huge volume, okay?
Mm-hmm.
And we got a down candle. What was it that kept you in this trade at this point?
The 5. Yeah.
Okay, the 5, exactly.
The 5.
Five is a huge level for any stock. A lot of changes for a stock that are under $5 versus a stock that are over $5 in terms of what they have to do, the hoops they have to jump through with the SEC and all that. But the point being is here, we didn't necessarily care for this chart, but let's see how the day shaped up. Since we had already taken profits here, we just pretty much decided, let's just see what this 5 level has to hold.
Mm-hmm.
It held once, it held twice, 3 times,
Yep.
and that was enough to frustrate the shorts.
Yep.
Back up. And then I showed that chart earlier when you see a nice green candle followed by pretty much another red candle. Well, to me, that looked kind of like a reversal.
Uh-huh.
And so this honestly kind of spooked me a little bit. It couldn't get through the round number of 6, so I started thinking, well, maybe we're just going to settle in here into a range. It's time to take profits up at the upper end of this range.
Right. And I think it's important to remember, guys, we talk about volume, and you'll hear us talk about volume a lot if you look at that 4 chart. Well, just look at the going back to the 1st of April. Look at the volume as it goes higher versus the volume as it pulls back. Okay, that's what you want to see if you're long a position. Okay, you don't want to see the opposite. You don't want to see the going up on smaller and then getting hit on bigger red volume bars. So that's the kind of action you don't
want to see that. Okay.
No.
You want to see volume push up, pull back on light volume.
Lesser volume.
There's a question, and we'll get to it. I think when you enter on the intraday, do you set the stop on the intraday or the daily? I think we're going to come up, we're going to come up on that point too, John. Mm-hmm. Okay. Volume reversals. Again, I'll let Andy explain what he was thinking on this chart.
Yes, this is one I actually kicked myself, and the reason I did is because I didn't take this position, and the reason I didn't, if you go back to that like March 17th, 18th in there where you see that big green bar, okay, the stock had just been getting killed, very much like the UNG chart, and then I remember that day I was calling it out in our live service. I said, "Man, I really want to take this." The reason I didn't is because they had a secondary out there on the table and I didn't have any idea what this secondary pricing was going to be, and but still, what I should have done is taken a position on that big volume day. I didn't, my mistake, but you don't catch them all. But That's a nice little example right there. You had a stock that came down, tested that 5 level twice, and the day after earnings, you had a big green. This is actually the second day after earnings. Terrible, terrible earnings, just horrible. And then you had, no, take that back. You had these 2 doji days. See those 2 doji days right above the line that Steve just wrote? Okay. It had 2 days after earnings where it could not go down. Just put in 2 doji days, and that's when I was telling our service, I said, man, this is a really enticing entry here for a swing trade because just horrible earnings, and it could not go any lower. And then, of course, you had that secondary out there, and that's what kept me from doing it. But you see that big volume right there? Well, look, it hasn't never looked back.
Again, how did the stock react to the news? It's not what you thought the news
right.
or how bad the news or how bad you thought the earnings were. How does the stock react to it? And you can see it didn't react as you would have thought. So that tells
right.
you that that news or that information is pretty much modeled in or already priced into this thing.
Mm-hmm. And that's one of the things that actually really scares me are secondaries, man, because their stocks can get so funny because you have a secondary offering. I think that this one is right around $5.25, the secondary pricing on this one.
Mm-hmm.
And man, you just never know. I've seen stocks just go down, and you got to be careful with that. And they'll go down and try to shake all those people out who got in on that secondary at $5.25. So anytime I get a secondary, guys, I hear of it, I just I get scared.
Yeah, yeah. More often than not.
Really, yeah, you never know how a stock's going to react off a secondary.
It's like printing more money. It just dilutes the currency. It dilutes the stock, and it usually is not a good thing. But in this case, the price action said otherwise.
Mm-hmm. That's right. I think we have another one coming up on GE, which is a nice little example of a volume reversal.
Climactic volume is what I like to call this. Okay, and I'm calling it climactic because you have a giant volume spike, but you also have the price action with a nice wick. What that means is intraday, that the chart probably went down and then put one of those V-shaped things intraday on a 5-minute chart, and that shows up as a wick on the daily. And when I see the price come down and then put in a long wick like this with this climactic volume bar, that really gets my attention sometimes. It's not always a symbol of a reversal, but it really gets my attention to look for one. And once I start looking for it, what I want to do is I would really like to see this wick hold. In other words, I don't want to see the price action really come back down into this wick. I'd like to see this this body here become the current support. Now, that being said, you still want to give it probably 50 cents or so, because you don't want to get wiggled out of these things, and you want to stay focused on the daily chart, not so much the intraday. But after a big move down like that, and a big volume spike, and a big wick, I'm looking for a bit of a reversal. To me, all these things here on a daily chart kind of get my attention as a possible reversal. And I'm sure you got some thoughts on this one too.
Yeah, by all means. You love seeing that. Now, you don't want to assume this is a case where, unlike that Alcoa, where it never the bar still finished red, it still finished down the day. I mean, it's I think it's called a hanging man or something like that, or a hammer.
A hammer.
Yeah, it's a hammer. That's usually a bullish sign, and which takes me back, guys. If you don't know candlestick charting, if you're not familiar with it, I would highly recommend that candlestick charting book that we mentioned there. But anyway, this is not a position I would take on that day because there's still a lot of negative sign. It closed lower on the day than the prior day, but this is one you'd watch, and where I would think about entering it is on that third day when it takes out that high right there, where Steve's you have a when it takes out that high. It's still a tough entry there, but this is one where you want to use the scaling in approach. And guys, we didn't mention this. I'm going to mention this right now because it's not in our webinar here. Commissions are so cheap these days. Okay, if you're using a broker and you're paying $200 a trade, take control of your money. Get you a broker where you can pay $7 to $10, whatever it is. Guys, you can get stopped out. You can get back in. I can't tell you how much trading I do in my long-term account, and I'm not least bit concerned about commissions because. A lot of people, they won't pull the trigger because they don't want to spend another 10 or 15 bucks on commissions. Well, you're going to get hurt a lot more letting the stock run against you than getting out. But the point I'm making here, this is a good example. where you could even take a quarter of your position, a fifth of your position, whatever. If you want to buy 500 shares eventually, buy 100 shares. Buy 100 shares on that third day. Okay, if it goes back and takes out the low of that wick, you get out and you lose maybe 70 or 80 bucks. So the point I'm making is you can I hate to sit there and be a talk about picking bottoms, but there's an effective way to do it where you can limit your downside and you really can be rewarded in the future if you're right. And if you know the things to look for in reversals, and you get the scaling in down, you can really position yourself well, in some of these patterns.
And, if you're able to, guys, again, these are current charts, so the longs have been working, so we're looking at bottoms. You can apply these same things to the top. If you flip this chart upside down and this price action went and wicked up through a price and then started to fall back down on big volume, it's just the exact opposite. Just flip the chart upside down in your mind, and it's the same mentality putting on a short trade.
Mm-hmm.
So I know we have a lot
of... I was going to say, or if you're long, and that would be a good sign for me to start taking profits if you saw that, yeah.
Okay, exactly. If you're already positioned and then you see that, whoa, that we just had a big, say this thing spikes up. Let's say eventually this is a good trade and you're long here, and we get up here and we have a pretty good move and we spike up and then wick back down through that 200 period on big volume. I might be looking to consider that a place to put a stop, because we could be looking for a reversal here at some point. So if that makes sense, it's kind of hard to follow my scribbles, but flipping these charts upside down for the shorts, for the short side, or like Andy said, knowing when to take profits, you can identify volume spikes and big wicks on the daily chart as possible short-term reversals. What brokerage do you use for swing trading? Well, Nick, Andy's brokerage is, I don't know, who are you using? I think we lost you. Are you on mute there? Oh.
Huh.
Okay, you were garbled there for a second. Try again. Hello. All right, I think he'll be back in a second. He's having a momentary sound issue. Nick, he used to have, like I said, an expensive managed account, and he just essentially he's trading his self-employed self-employed account, SEP they call it. Let me see if I can get Andy on here. He looks like he's resetting his audio. Okay, it looks like you're back.
Okay,
I hear you. Yep.
Okay, good.
So who are you trading through now for your SEP?
Yeah, I'm trading through Ridex, but it's just only reason I'm doing that right now because a friend of mine is a broker there, and I'm actually paying too much. I'm paying $15 a trade, and I'm doing too many trades, so I think I'm probably going to be possibly moving over to maybe Ameritrade. You can go with anybody. It's as far as E-Trade, Ameritrade.
Point being is don't have an expensive broker doing the trades for you. There's no reason to pay somebody to do the trade for you.
No.
Okay, so moving averages. This is the Apple chart, okay? Let's talk about what you were thinking here as a possible entry using the moving averages on a daily chart.
Yeah, first of all, I'd like to make a point, guys. I don't want you, because we've talked a lot about volume and bottom fishing and volume reversals. I don't want you guys to get the impression that all we do is go around looking for bottom fishing stocks, because that's only a small portion. I don't do a whole lot of that. If I see the right setup like that UNG, yeah, I'll jump on it. But bottom fishing is dangerous, and the only way I'll do it is if I scale in and I use tight stops and get out when I'm wrong. But that being said, this is using moving average a lot. This is a good example of maybe an Apple here. If you see there at the Steve could circle it the 1st of February there, where you see the stock had a nice little run up, and it pulled back on less volume there, and then it came right down to its moving averages, and you had the 10 period right there crossing over the 20 period, so it had some convergence there, and the stock came down, and it's just an example of using moving averages. I'm not going to go too detailed into this, but trend lines, moving averages, those are good spots to take a little chance, on entries.
Mm-hmm. Also, going back, look at this wick here. Let's say if you had, for whatever reason, were long this stock, and I saw this thing close out like this. The volume isn't that climactic, but at the same time, I see that big wick above that $100 psychological level here. What is that level it's wicking above? And so back here, all we had to work on was this information. If I was long at 90 and trying to play a range here, and I saw this thing could not close above 100 with a wick, I'd be looking to get out pretty quick because I'm thinking short-term reversal is coming. And in this case, that wick did hold true. It pulled back $15. So that's just something that it's not an end-all, be-all. I'm not saying base all your trades. We're trying to talk about putting all the pieces together: trend lines, volume, psychological levels, support, resistance. It's just not one piece. It's many pieces. So I think we're trying to move you guys into that direction, into looking at all the pieces of the puzzle. Okay.
Mm-hmm.
No, we don't want to end show. We want to move on. What am I doing here? Oh, I don't have anything to draw. No wonder. Okay. Okay, scaling in and out of a trade. Back to the UNG chart, and I think we actually maybe got ahead of ourselves because we did talk about how you scale it into this trade, didn't we?
And we did talk about that, and we did get a little bit ahead of ourselves. I forgot we had the scaling in and scaling out, but we can actually talk about the concept again because we did talk about scaling out. So let's, scaling in is I use it quite. I would say about 8 out of 10 of my trades I'm using the scaling in approach, where I'm just taking a third, sometimes a half of a position, and if I'm wrong, I'm using tight stops. But an important concept also is to scale out and ring the bell when you get some profits. I can't tell you how. There's nothing worse than watching a profitable trade turn negative. That's even worse than getting into a trade and just having it go straight down on you. You don't want those. You can't let a stock reverse on you and turn into a loser if you have some nice profits in it. And so what you see when you get it, whatever you use, when you get a good move, I like to use chart patterns. Say, for example, in this UNG, my well, I'm not going to get ahead of ourselves again, but because we'll talk about target objectives later. But there's points in there where I'm looking at to where I'm probably going to ring the bell on some of this. It's not going to be anytime soon because I think I have a pretty nice trade here. But Steve's showing some possible areas that you might look to ring the bell, ring the cash register, whatever you want to call it, and take some profits off of even if it's only a third of your trade. But the point being made is, as your stock moves in your favor, guys, take some profits. Just peel some off the top, man. Just because the beauty about swing trading is, if you do peel some off and it pulls back on it, you can always get back in some more. And I do that kind of stuff all the time.
I don't know when, but I fully expect the price action to, I see this 10 and 20, I expect these to kind of continue up. And at some point, I expect the price action in UNG to fall back into these averages again. And when that happens, maybe an opportunity to add to a winning position, or maybe buy back what you sold earlier. But I think this is a good trade he has. He's got something that other people still want. You haven't even heard them talking about this on CNBC yet. So, and that's another good point. It's still kind of under the radar. The public's not really on this trade. There's not a lot of buzz about it. And if you can identify the fact that you're in early, you got something that other people want. Don't get out too soon. But like Andy said, there's nothing wrong with adding on strength. But play this thing for what it's worth. If it pulls back into the moving averages, I think this thing could still be in play.
Mm-hmm. Yeah, it's definitely looking like the early stages of accumulation phase right now. But
yeah. Okay, so we just talked about scaling in. Some people say, well, aren't you averaging down? And absolutely not. And I'll let Andy explain the difference.
Oh yeah, I mean, it was scaling in. Say I look at a stock and I want to buy 1,000 shares. Okay, well, I'm not sure. Like that UNG. Do I have a bottom here? Is this a good spot? I'm not sure. I'm going to buy a third of my position. Moved a little bit higher. I bought another third. Okay, so I'm looking at possible pullback to add another third. Now, averaging in is if I would have just say, oh, I like this chart. Whatever I'm looking at, I'm buying 1,000 shares, and I buy 1,000 shares. And guys, I see more and more people do this, and this is
Deadly.
It is. It's such a deadly game, and we'll talk more about you're wired to do this. Okay, stock goes against you. Oh man, this is not happening. I'm going to buy another 1,000. And I see it in day trading. I see it in long-term trading, where they average down on their losers, and they take their. We'll get more to that, but just do not do it, guys. If you're wrong, okay, and get out of the trade.
Here's scaling in, buying a third, buying another third, and then breaking out, maybe buying another third. There's your 1,000 shares. Okay, this is averaging down, buying 1,000 shares. Stock goes against you. Oh shit, I was wrong. Buying another 1,000. Don't do that. The trade is broken. Don't try and prove yourself right. Listen to the price action. It's telling you were wrong. So that's the difference between averaging in. Some guys saying, well, I really liked it at 13. Well, now I can buy another 1,000 at 12, and I've got an average price of 12 and a half, and maybe this thing will go. Well, you become a hoper, and the price action is broke. You really need to pay attention to what the chart's telling you. So that's the difference, and hopefully that makes sense between scaling in and averaging in. Okay. And just a good quote there we pulled from the Reminiscence of a Stock Operator book. Of all the speculative blunders, there are few greater than trying to average a losing game. Always sell what shows you a loss and keep what shows you a profit. So easier said than done when you're in the game, when it's real money. It's hard to adhere to, but it's so correct.
Mm-hmm.
All right, stop losses. For people who are not actively day trading, people who are on the road or who have a day job, trying to actively manage money and watching their downside is very important. Always watching your downside is one of the most important things, is managing risk. And this was a chart that would have really caught you off guard had you not been at least putting a forethought of risk management in there. And I'll let Andy talk about it.
Yes, this was actually a trade I was in, guys. I'd had a pretty good entry in it, so I was in at a good price. I'd actually had been in it for several months, and I even had a stop loss in it. And thank goodness, because you could see there on the those last two bars. You don't even have to look at the second one. You just look at the that first red bar down on the far right, and I think I stopped out at the lows of those. You can see the low back over there. Yeah. I stopped out of that, but I know there's people out there that was long this thing that didn't have stops on it, and they come in. Excuse me.
And let me just also add, this is important to note that this was a tradable event. There's nothing you can do to protect yourself. Say, had this been a big gap, let's say some news came out, or Amgen came out and warned, we're going to miss our profits. Chances are it would have gapped down, and you would have been screwed either way until the price opens and starts trading. But maybe it would have gapped down to here, and you wouldn't have had a chance. But in this case, this stock actually traded. This red candle indicates it opened up here and traded all the way down through. So had you had risk management in place, you would have really protected yourself from further erosion if you weren't paying attention. Are you there? I think every time you go on mute, you have some problem coming back on, it sounds like. Yeah, he's having to recycle his audio again there. So again, if you're not able to be in front of the screen and analyze the price action, the only other stop and protection you have to give yourself an amount of risk management is using protective stops, and you should have those in there. And I know, your open positions right now, you have some stops in there, correct, Andy?
I do.
Just in case.
Yeah, you have to use stops. Yeah, you have to be careful on some of those thin stocks, because if you put them too tight, sometimes they can. Yeah, you can get stopped out of Some of these brokers out there, they have funny, some people use print, some people use bid offer, so you have to be really careful of where you put your stops. I'm kind of lenient with mine. I mean, I'm not buying a stop and putting a 25-cent stop on it. You're going to get stopped out. I mean, it's just going to happen. But at the same time, you want to look out for a chart like Amgen where it just falls out of bed on you. And if you don't have a stop out there, you come back the next day and you're just like, oh man, and it's gapping down further and going lower.
And then that begs the question: where do you put the stop? So then you have to start looking at this chart and saying, okay, well, if I'm going to manage my risk, where on a chart like this would I manage my risk?
Yeah, exactly.
And so in your case, you put the worst case doomsday scenario below that level there.
I did. It was that was one that I had a pretty good entry, and it's a biotech, and these things have a tendency to have some pretty good moves to them. So if you try to draw a trend line there, use a moving average, you can get stopped out pretty quick. So I think I ended up getting out for basically like a flat, maybe a little winner on that one, but I didn't have a really tight stop on that. And a lot of these guys, you're going to have to use your own judgment. What are you looking for? How tight are you going to use your stop losses? That's just a matter of personal opinion. I mean, it's going to be different for different people. Some people may use a trend. Some people may use moving averages. Some people may want a chart to completely break down. Or in other words, just because a stock breaks a moving average or breaks a trend line doesn't mean the trend has changed, if that makes sense. So you're going to have to you take this and create your own ideas as far as how much profit to take, where the stop loss is going to be. It's going to be different. People's level of pain is varies, and so this is where you're just going to have to draw your own conclusion and ideas as far as where your stop losses go.
There's a question, just quickly. Where do you think you can get a better return on percentage, day trading or swing trading? That's a question I'm posing from Nick. And I'll ask you that, Andy. I know swing trading's been pretty good as of late, so that's a tough one.
Yeah, but no question. I've made so much more money day trading than I've had swing trading. I've had a really great run on swing trading account because I was fortunate enough. You've been through a few bear markets, and you kind of get a feel of when you may be trying to put in a bottom. And plus, we're on it on a daily basis, so I can watch my stop losses. But I picked off some stuff. Got fortunate enough to pick off some stuff pretty close to the bottom back in March. But no, long term over the last since I started day trading 11 years ago, no question. I've made so much more money day trading.
You can get some good. Yeah, it's been a good environment in the last couple of months. You've had a pretty good performance in your swing account, but it can go a little soft for a while because we've had some things that are really ripping and really getting some good, quick, fast returns. But over the long haul, I think the consistency, if you're able to find a good method and have the right temperament and be a consistent day trader, you can bang it out more consistently. Yeah. It's tough.
Now, if I could get the same margin, day trading, if you had a huge account on swing trading account, I think you could do really well. But you get a huge margin on your day trading account versus you don't get any margin on a 401k and or SEP and so. But I kind of prefer it that way. I'm not that much of an avid swing trader that I want to start trading on margin.
We already talked about target objectives, didn't we?
We went over it briefly, but that's those are just areas, whether it be support, resistance, moving averages, that you look at where you want to take some profits, peel some off.
Let me ask you this: there's this line there, and then there's the 20 up there. Do you lighten up as you come into these resistance levels to take a little bit off the table, or what are you going to think about if we get there?
Yeah, every trade is different, and on this trade for me, I'm going for a bigger move. I'm priced right. Sometimes I like to say, hey, I possibly picked the bottom, of this trade, and I got a great position, So I what I call going for the juggler.
That doesn't necessarily mean I won't take some profits if it gets up there, to that 20 level. It's hard not to do, but at the same time, I think when you have the guts to go in and bottom fish like that, I saw a lot of people, selling out their whole position on Friday on this thing, and I just think you're leaving a lot on the table. You see those 2 volume bars. You know what? I'm not saying that nothing's a sure thing in this business, man. This thing can be covered up with 2 big red bars. That's the thing about markets, man. It's just you never know. I mean, you guys don't assume that I'm talking about this UNG that this thing is going to just reverse and go back up to 40, because I have no idea. But all things that I'm considering right now and all this, and what I'm looking at, the technicals and what they're telling me, I think I have a real good position here. That's not saying you guys should go out and buy it on Monday, because this thing could pull back to the moving averages or something like that. I'm not making any recommendations here. I'm just saying that I caught it for right now. Everything looks good. I caught a real good position, and I'm not looking to sell right now. I'm actually looking to buy more.
That's a good segue. It's perfect, because Jerry's question is, if you're averaging down, it reduces your cost. Won't averaging in reduce the amount of profit already made? The idea, Jerry, is we want to add to winning positions. And I'll let Andy expound on that. He's got a much better perspective.
Oh, sure, and that's what you want. You have to reprogram the mind. We're going to go back in that. It's actually one of the last topics we talk about. So many people add to their losers and they take their profits too quick. It's human nature. It's the way we're wired, and you have to, if you want to be successful and make good money, swing trading, day trading, whatever it is, you have to learn to do the opposite. And guys, I'm telling you, I get more emails and more questions from clients, and that is the number one prohibitor for people making profits in day trading and swing trading. They tell me, they say, I cannot let my winners run. How do you let your winners run? I'm always taking profits. I get profits. I can't help it. I take them too quick. And
very common.
It is, and it's what it is. It's human emotions. It's the way we're programmed, and you can reprogram the mind. And there are ways to do that. And one way to doing that is ringing the bell, taking some profits as it goes up, and then not even looking at letting the last bit ride for you. Put a stop in, just like you do in your losers.
And Jerry, the whole scaling in mentality is more like dipping your toe in the water versus just jumping in head first without reading the sign of how deep the water is. So it's another function of risk management and watching the downside. That's so crucial. And just plunging in and then averaging into a losing position is just jumping into the shallow end head first. I'd rather dip my toe in and see what the temperature is, and then maybe dip the other foot in and kind of leg in that way.
Yeah. When I'm day trading and I have several positions, I have 7 or 8 positions, which I do all the time, and I'm trying to manage them, for the most part, all I'm doing is looking at the red ones. I want to manage those red ones because the green ones are working for me. I do the same thing. I do the same thing in my long-term account or short-term account, what I'm looking at. I go look at the end of the day or in the morning. First thing I do is I pull it up. Most people will go and look at those green ones and say, oh, man, it's had a nice run. I better take profits. Now, the first thing I do is go to the red ones because I want to know what's not working and where do I need to cut it.
Okay, avoiding shakeouts. Very hard to do. The market really is a mechanism designed to constantly shake the trees and see what loose fruit comes out. And staying in a good trade, that's one of the hardest things, like we just came off the topic there, is how to stay in a good trade, because this market is designed to try and head fake, fool, and shake people out most of the time. That's a quote right there from Livermore. The market is designed to fool most of the people most of the time. Go ahead, Andy.
Yeah, that's, and this is probably one of my biggest faults in my. It's very, very difficult for me because I'm constantly having to watch. I'm here 7 hours a day, day trading, and so I'm having to, watch these long-term positions as well. On an intraday basis. Yeah, and it's very hard to disconnect the two. I mean, I've gotten better over the years, but it's difficult because I can think of, and I'll show you guys. I had a BGU trade. It's a triple bull, a large cap ETF that I bought. I mean, right at the bottom, about 50 cents off the bottom back in March, and great position. And yeah, I sold it too quick because I got fooled by the intraday, activity, and basically I sold it at, like 21. It's at like 35, 36 now. But anyway, it's hard for me because I'm having to watch it on a daily basis, and but we're going to talk about that. And because this is even more important in position trading or short-term trading than it is in day trading, because it's really easy to get shook out of positions.
So paying attention to what the overall market is doing is one good thing. Relatively, how well is your stock performing relative to the market? Is the market up 200 points and your stock is down 3% on the day? Things like that.
Exactly. And yeah, if you feel your stock pulling back on you, it's getting close to a moving average, and it's actually dipping below it, what's the market doing at that time? If you have a good position and it's trying to shake you out, is the market selling off? So you definitely want to look at all the whole picture.
And again, we talked about the closing price of the candle on the daily being very important, and it's not one or the other. Look at both. Where are the support resistance lines? Where are the trend lines? And where are the key moving averages? And is the candle of that particular day trying to shake people out in the middle of the day only to turn around and close? So do what you can to keep your stops as liberal as possible, because it's a longer term time frame. Because many times you're going to look back and I'm sure you guys have all been there. Everybody's been shaken out of a good trade. We all know what it feels like.
Oh, yeah.
We all know what it feels like. And so we're trying to do everything we can to avoid that. And the only thing you cannot control the market, but you can control your attitude, and you can control your share size. So, like Andy said, in day trading, you've got bigger share size and you've got margin to work with for quick hits in and out. But on the daily time frame, the whole idea is to stay in the game and not get shaken out. So if that means downsizing on your volume shares to allow you to have a little bit more of a liberal stop, to allow for these intraday shakeouts, where if you look back on the daily chart, after all was said and done, it still wicked back up and closed above its trend line or closed above its moving average line. Those are the things you want to try and continue to monitor.
Exactly.
All right, here's some charts that we'll discuss a little bit of wiggle room here, and then maybe some graphical analysis of how they tried to do it. So I'll let Andy hit on them.
Okay. Yeah, this is a good example of AX American Express here, and as you can see there this one's an example of the 10-period moving average right there. I mean, you see the intraday, it fell below that 10-period moving average, and I'm sure it wicked a lot of people out there. I wasn't in this trade. But at the same time, it went down, shook out, I'm sure, a lot of people.
Actually, let's actually say what it is. It never really went down. The way this candle did is it opened up down here.
Right.
So the bottom end of this body is an opening. So it gapped down. So here's a case where the market opens and you're holding your breath. Oh, my God, we're gapping down below the 20 period. Don't panic out and hit the 10 period. Don't panic out and hit the sell button just because that's where it's opening. You got to be able to have a little bit of patience and observe the price action. And as it were, look at that. It popped right back up and wound up actually closing back above its 10 period. Now, the very next day, pretty much closed right on its 10 period. I don't really care for that wick. Let's just assume that we don't have this extra day of data, and I'm looking to figure out what's going on here. Well, good news and bad news is bad news is big wick. I don't care for that, but the good news is it's still fighting its 10 period. It closed pretty much right on the moving average, so that's still close enough for government work for me to stay in this trade. Next day, price action takes out that wick. So if I was short, I wouldn't want to see that. Big volume, moving up through that wick, closing up through its moving average. Once again, time to stay in this trade. And if you're even on your game, you'll notice it closed very close to its high of the day on monster volume. Remember what I said when you see a stock closing near its high of its day on absolutely monster volume? It might be a good idea to maybe think about taking some home. And in this case, look at that. The Synapse jumped up here. And the people who missed out on the close of this day, whatever the news was, whatever the story was, they wanted in, they had to pay up. So you went home this day with something that they wanted the next day, evidenced by the way it closed on that big volume bar near the high of the day, recovering on its trend line, recovering on its continued move.
Okay.
All right, so let me erase that, and we'll see what we got coming up next here. Another wiggle room chart. Okay, what do you see in here?
Yeah, this is one. It's not that pronounced here, but I just kind of wanted, I was looking around just for an example. A lot of people will use whole numbers. And if you look in March on this is Diana Shipping. If you look in the middle of March there, you got that 12 level. And like I said, this is one I just picked out where, say you got in this back in the 1st of March there, and you got in this chart and you're saying, well, I want it to hold this 12 level. I don't want to get out. Well, look, went down there, dropped, went below its that 12 for about 3 days, and then it just popped back up. Now, there's nothing strong about this chart at that moment, but like I said, there's several different reasons why somebody may have entered a trade. But the example I wanted to make here is, especially around whole numbers, I see, because I've learned through experience, if you put those stops, right up below the whole numbers, whether it be 1290, 1280, 1270, there's a good chance you're going to get wicked out. So I try to allow myself a little room, if I'm looking at whole numbers. And a lot of times I'll allow myself, 60 or 70 cents, or maybe even depending on the stock, if it's a $40 or $50 stock, you might want to allow yourself $3 or $4. But the point being is, this markets are designed to shake people out. It happens all the time, and you get out of good trades. So just give yourself some wiggle room. There's going to be slippage. It's going to happen because it's designed to shake people out, and you don't want to be those one, the one shook out.
Also, just a quick observation here. You can, if this was me and we're closing here, and I'm trying to figure out, okay, well, this trade is obviously it's not breaking, it's breaking down, and I'm a little concerned. I don't want to get shaken out, but what is really going to be my drop dead point? I would have gone back, as you always do, go back on the chart. You do have a bit of a gap here, and a lot of times stocks like to fill their gap. Well, in this case, it didn't. All right, it didn't. But I would have been looking at that and thinking, oh boy, I think the worst case possible would have been like it's probably about $1 stop loss here below 12. But it never came back to that area. Well, look at this. We did have a gap up here the following day after the shakeout didn't materialize, and wouldn't you know it, the price did kind of come back and fill that gap there. So also take a look on the daily charts for gaps. They can be places that the stock price wants to gravitate to.
Sure.
And many times will complete that pattern. So always be aware of gaps behind you, because sometimes gaps, you hear backing and filling. This is a classic case of backing and filling. The stock gapped up, wanted to go, but quite honestly, it really had to back and fill first before it was able to move higher. So if you're not paying attention to gaps on charts, here's another gap here that eventually was filled. All right. Waiting on market direction, and this is a classic one. Andy always quotes Livermore saying, after spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this: it never was my thinking that made the big money for me. It was always the sitting. And what does that really mean, Andy?
Well, and guys, I can't. We talked about attributes of a good trader, and I think patience, by far is the biggest virtue when it comes to trading. A lot of times, I mean, stocks ebb and flow, charts ebb and flow, and I see so many traders that chase after the money, and I just you don't want to get in the habit of doing that because you have to be patient. They will come back. Worst case scenarios, you don't get the trade and you didn't lose any money.
Like that UNG, I wouldn't buy it here. There might be a place to buy it in the future, but I wouldn't be here. This would be a chase. He's already positioned in that trade. Like I said, there may be a point where it falls back into its moving averages, and it might be worth another look.
Right.
But for now, you don't want to chase, and you don't want to have to feel like you have to be in the game. So I got to find a stock I got to be in. You got to consider yourself more, like a tiger, just waiting in the weeds and stalking and watching and just waiting. Right. Like Livermore says, it was his stalking and waiting and watching and waiting for that moment to pounce.
Exactly.
That kept him from being in trades that were half-baked, half ill-conceived, taking up capital and energy when he could have been spending that time better looking for a patient entry.
Sure. And you definitely want to, and that doesn't mean a stock, just because it's had a huge run, that doesn't mean it can't consolidate for a while, and then there still may be an entry, but I don't, like chasing big, 4 or 5 big green bars, and I see people, that's where the greed comes in, and people think, oh boy, this thing's is going to go to the moon. I don't want to miss it, and they start chasing. So be patient, wait for your entries, and wait. More importantly, if the market's not doing anything and you're not sure what direction we're headed, As a matter of fact, when we go to our question and answer, I'll take a look at the spiders and see we've got some major resistance overhead and possible area we may go to where I'm looking probably to. I've been ringing the bell, but a lot of stocks, but boy, I may be going into all cash because. And I would highly recommend that. If you get to a point where you don't know what the direction of the market, sit in cash.
Cash is a position.
Yeah, exactly.
Cash is a position.
Yeah, wait till the market, dictates, shows its hand.
All right. And again, the biggest email that we get is, "How do you let those winners run?" So, here's a few ideas. I need to step away for 1 minute. I'll let Andy read the slide.
Okay.
Be right back.
Yeah, I'll talk about it. Yeah, we're talking about cutting losses and letting winners run. We touched on this, but I think it's important we actually touch on it a little bit more because there's only two ways to improve your profits in day trade or any kind of trading, okay? And that's cutting losses sooner or letting your winners run longer. And what I like to do in day trading is have at least a 2-to-1 ratio. Okay, for every $1 I lose on a trade, I want to make $2 on the upside at least, and I really shoot for 3-to-1. That's a minimum goal. That's not something where I'm just trying to do. I mean, I at least want to do that. And guys, I'm just going to keep driving this point home because I see it happen all the time. People taking those winners too quick and letting the losers run against them, and that is a losing game, and you're going to die broke if you keep it up because too many people you listen to, whether it be tips, and that's another thing. Do not ever listen to tips. People, talking heads on TV, analysts, upgrading stocks. I don't listen to analysts. I look very. I don't even read a lot of earnings reports or fundamentals. I really get to the point where I trust the technicals more than I do the fundamentals, and it's because accountants lie, analysts lie. Nothing surprised me what happens on Wall Street, so a chart can tell me, guys, a lot more than what I can hear on TV or what I can read in an earnings report. So getting back to the point, guys, what I'm driving home right here is a lot of people, they listen to analysts, they read reports, and they get married to these losing positions because of what they're hearing out there. And don't do it, okay? Let the price action dictate your exits.
I just missed the last 2 minutes, but I don't know if you mentioned, like we said, it's not even on the radar yet, but you might start hearing some people talking about, UNG, and that could start to bring some euphoria in it. But again, it's not just because they're starting to talk about it on TV doesn't mean that's the reason to jump in.
No.
You got to have a technical reason to want to give yourself the best entry, to allow yourself the most wiggle room, and to not get stopped out of a trade.
Okay, yeah, and this is a very important Livermore quote down here. I'll let Steve read that one. I didn't read that bottom one there. I talked about some stuff.
And when the market goes against you, you hope that every day will be the last day, and you lose more than you should had you not listened to hope. And when the market goes your way, you become fearful that the next day will take away your profits and get you out too soon. Now, the successful trader has to fight these two deep-seated instincts, and they are correct. They are deep-seated instincts. Just like, I think let me see if we don't have that on there, but I use the fight or fly analogy. We're all wired as human beings. If a gunshot goes off and we all, react to it and run for the same door, that's herd mentality. We're hardwired to do that. We can't help it. And so when the market goes berserk and goes running for the doors, we kind of have the same reaction, and that can be very difficult to overcome. And you have to overcome that to go against the grain and go against the herd to be able to survive in the long run and making trades pay for themselves.
Yep, and this is what you have to do, guys. I mean, you want to do the exact opposite of what he just says right there. I mean, you want to fear that your losers are going to turn into bigger losers, okay? And you want to hope that your winners will become more profitable. And so basically the point is you have to reprogram your mind. We'll talk more about that. I think that's our closing topic, but we'll hit on it again.
Yeah, and just as a, trust me, it was one of the biggest mistakes I made in the first year or two. I had some albatrosses around my neck that I would come in day after day. I was mixing swing trading and day trading, and I would come in and maybe make a couple $1,000s day trading, only to watch this stupid stock that I've been holding on to suck two more $1,000s out of my P&L because I didn't let it go. And it takes away your mental focus. It takes away your ability to scan the market and look for opportunities, because half your day is spent nursing a bad trade. And it just, I can't emphasize enough how much it sucks the life, energy, confidence, and money out of you when you sit in a losing trade that's just not working for you, and you no longer have a reason to be in it.
Okay, Nick has a question over here. I guess we have missed a question. How long does a stock need to trend until you say to yourself, it will keep on trending? You know what? I never say to myself, you know, what it's going to keep on doing. I have no idea what the next day brings, Nick. So, you know, it's like that. It's like I just said in that UNG. I love my position right now. I got a great position. Volume's coming in. Everything tells me that, you know, the footprints in the sand, I should say, tell me it's going to keep heading in the same direction. But I never assume anything, and that's why you constantly have to monitor your positions.
There's too many variables, Nick.
Yeah, it really is.
The market could turn around. The sellers have just been absolutely run over in the last 8 weeks. Now, that's not to say that they might not gain control here in the coming 8 weeks. And everything that we're talking about to the long side here will need to be, you know, kind of inverted. You know, and that's only to say if we get back into an environment where the sellers take control, where every rally is faded, and we'll look at the S&Ps, and just quite simply, I use the 10 period or 10 and 20 period as a basic guide as to who has control of the market. And when we look at the S&Ps again, we'll show you that the bulls have had control, as evidenced by the 10 period momentum line. This, prior to that, January and February, we showed on the very first slide, the bears had control of this market. So, you know, that's going to determine also when a trend line is going to break. So there's not just one thing to look at. There are many different variables.
That's right.
Okay, this is a kind of a unique, and this was a good idea that Andy had. You know, a lot of people that are going to maybe be trading their retirement accounts, if they are trading a retirement account, they're not allowed to go short. And you're just not allowed to short sell stocks. However, there's going to be times when you may have 3 or 4 long positions and you feel like the market might be due for a pullback and you're feeling a bit helpless. You don't want to sell out of your positions, but again, you just have a feeling that you might be having to suffer a bit of a pullback. You can do what's called hedging, and hedging is simply taking a position that benefits from the prices going down, and what that can do is offset your losses from the longs that you're in. So a lot of professional money managers use options or other straddles or other hedges to offset market pullbacks. And I'll let Andy explain why these ETFs are the best ones to use as opposed to some of the others.
Yeah, these are ones that not as popular as your FAS and your SKFs and SRSs, because they use more by day traders. They do a lot more volume in a day. But when it comes to hedging your long-term account, I would definitely avoid the leveraged ETFs and go with the ones. The dog, that is the inverse of the Dow. Okay, so that's going to just move exactly opposite of what the Dow does. Okay, and the SH is the S&P 500. That's going to do, once again, inverse of the S&P 500. So essentially, being long the SH, you're going to be short the spiders. And this PSQ is the Nasdaq, the quadruple Q, and so. You're going to be short the Nasdaq. So, what I would like to do, I mean, I'm so happy that they came out with these things, because for years, you know, when we had a bear market, boy, there's nothing I could do in my life. I said, what am I supposed to do here? Just go into all cash? You know, it'd be like a mutual fund company that sit there and churn your account, and as it goes down to 20 or 30%. No, I don't want to do that. You know, I can see the market. I can see we're getting tired here. I'm pulling back. I don't want to be in anything. I'd love to be shorted, but I can't. There's nothing I can do. Well, now it's not the case anymore, because these instruments, these ETFs, are instruments that you can use to actually position yourself to benefit and capitalize in a bear market. And I would highly recommend them for, you know, if you've had a nice run in your stocks, and as the market's up 37% over the last 7 or 8 weeks. now may be a time to maybe put on a couple of hedges against your long positions. I actually did that in my, I tell you what, I learned the hard way and with these ETFs. Luckily, I didn't lose a whole lot because but anyway, I bought some, and this is when I've done this one time and I'll never do it again. I bought FAS and SDS, which is a double Dow short leveraged ETF. But anyway, yeah, I bought the FAS and SDS in my, and I got, luckily I caught it at the right time. I didn't buy it till like around 14 or 15, but anyway, I got out real quick for actually a small profit. But had I not gotten out, like a lot of people right now, the message board over there is just suicidal, and it's these are very dangerous. The point I'm making, guys, avoid these triples, these leverage. Just avoid them, especially in your. They're okay for day trading, but you don't want to get messed up and involved in these.
There's a lot of people, and it's kind of sad because there was a good period here where people were making some good money as the financials are crashing. And here's an example of, look at this horrible, horrible change of events in just 2 days there. And I guarantee people since 60 have been trying to revisit the success they had back here, and just to no avail. And it's been horrible. So this is 3 times the pain of a regular short, and it really doesn't need to be used anything on hedging or even for new traders. It's very dangerous.
No, very dangerous.
Okay, going into earnings. Many times you may be long a stock, and you know earnings are coming up here in a couple days, and you're not really quite sure what to do with it. So, very common situation. And here's a couple of ideas here. Go ahead.
Yeah, I'm not going to go too in depth here, because what I'll normally do, sometimes I'll hold if I have a good position and I'm up nicely in it. What I like to do is just go ahead and lighten up by selling. You don't know what's going to be said in those when it goes into earnings. I'm not saying I do that all the time, because if I have a small position and it's a nice little winner for me, I'll hold it into earnings. But if you have a sizable position and you're heading into earnings and you've had a nice little profits, I always like to skim off usually about half, because earnings can always hit you with a surprise sometimes.
Again, going back to
if it's a losing position, and I'll just get out.
Going back to those 2 charts we showed earlier, 2 different charts going into earnings. One company, I forgot who it was, but had already run 100% going into earnings. So that's when you really got to be nervous about, no matter what the results are, you've got to be prepared for buy the rumors, sell the news. Even if they're great earnings, how far has the stock come? Okay, has it been going sideways with great earnings? That would be interesting. But has it been going up 50, 60, 70% going into earnings? You really got to be careful. Don't be the bag holder, the greater fool theory, buying a position, turning around, selling it to the next fool. Don't be that last one holding the bag after a stock has already run 80%, gapping up on good earnings, because there might not be a whole lot of follow-through there. That could be called a crowded trade. There's already a crowded position of longs getting ready to try and sell to take their profits, and you don't want to be the one helping them do that.
Good point.
Here's a graphical illustration of a position, and I'll let Andy call it out.
Yeah, I want to talk about this, because this is a strategy that I use. As a matter of fact, these 2 examples are actually positions that I took in my swing trading account. This is one. You had Cisco. Cisco had a nice little run there. If you look back at the 1st of April there, went to a multi-month high, and then you had a downgrade. Good old analyst downgrade on it, So what I like to do, if you have a strong chart pattern and it looks good, and you get this downgrade from an analyst, is I like to watch it for a couple of days. And usually about that 2nd or 3rd day, once they've scared a lot of people out of the stock on the downgrade, a lot of times it's a good one to pick up. And I can't remember exactly, where I picked this one up, but I did buy it on that 2nd day. Small position, took a third of my position, and I think it was after that. It was the 3rd day afterwards. I remember right on that moving average there. But made a nice little profit. Sold it up there the other day, close to I can't remember. Don't get me lying here, but a nice little profitable trade. And if you'll go to the next one, I think is another example of. Go to the next slide.
Actually, real quick, let me address
Okay, sure.
Leo's question. Do the reversed ETFs charts reflect the same patterns as the straight ETFs? No, and I'm glad you brought that up because those, if you're going to be looking at daily charts like that FAS chart we just had up, there's nothing to be had from it. It's like looking in a funhouse mirror. It's completely unstable and completely distorted. So what you do on that FAS chart is you key off of the XLF, which is the single financial upward bullish ETF. And if you're going to trade, different, if you're going to want to trade the XLF ETFs, you have to base your decisions off of the single ETF because you can't look at the daily chart and expect to find cues of patterns because it's completely warped.
Well, I just want to clarify that I just want to clarify. Steve's talking about the leveraged ETFs. Now,
Yes.
the regular ones, the normal ones, will reflect
Okay.
the same pattern on the opposite. Yeah.
That's a good point because his question says, do reversed ETF charts reflect the same pattern as the straight ETFs? Okay. I was assuming, Leo, that you maybe meant a triple. And yeah, when we get into the question and answer, we'll show a couple of good examples of that too.
Exactly.
All right. Next chart. And we're still
Okay,
talking about buying after downgrades. So this was Tesoro.
Right.
Let's talk about where you were already long this position.
Well, I was actually already long back around 13, going back to March there.
Right in
coming
here?
off that moving average, yeah. And like I said, for me to remember all these exact points in time, it's tough. But I know I was positioned this thing. Luckily, as it went higher there on Tesoro, I did take some profits off in my long-term account on that day.
Right there?
But
Okay.
It popped out, and just taking advantage of the break there when a lot of people were coming in and buying. You can see the nice little volume bar. I took some profits. But I was definitely hanging on to the most of my position there because beautiful looking chart, breaking above resistance, closing above that 16. Everything looked great. And lo and behold, the next day, a big fat downgrade, and it just frustrates me.
Don't even get me started on that. But,
I know. Yeah. I mean, you get a beautiful looking chart like that, breaking out on good volume, and then next thing, yeah. So, okay, guys, that's what you want to play. That's fine. So it pulls back here, and I can't remember exactly what day I bought it on, guys, but I remember I bought it at 13 for a fact. I exactly got filled at 13. So
basically, you bought back some of the shares you sold up here. You bought them back
Exactly.
down here at 13 because you knew an analyst downgrade. Let's look at this for what it's worth, guys. It's an opinion, and I'll tell you what, these opinions are horrible. Sometimes they'll upgrade a stock after it's run 100%. Just like I said, it's the last thing you want to do. Now you can assume either one or two things: they're really dumb, or they've never traded before, or they're actually trying to bring the price in for somebody to help pick up some shares. And keep it as simple as that. I don't know what all the options are every time, but you just have to deal with it. And my point is, it's not a fundamental change in the company. The company did not come out and say we're lowering guidance. The company did not come out and say we're warning, we're missing our numbers. The company did not come out and say we're being sued, some material change of effect in the company's business. It's one guy's opinion, and one guy's opinion was able to bring the stock back $2. So how you trade off of that is
$3
kind of focused. $3. So how you trade off of that is what we're focusing on. So a good rule of thumb is to wait a couple days. When you get adverse news like that, wait 2 or 3 days. Here, look, here, good example. Downgrade come. Uh-oh, what happened here? People who didn't sell just found out about the downgrade, read the newspaper that night, next day gap down, follow through. So don't jump in here. Don't be the hero to jump in after the first day. We have kind of a rule when a stock gets hit, whether it's bad news, bad earnings, or a downgrade, at least let 2 days of solid selling wear itself out and let those people get out. Give them a little room, a little time to hit the doors before you maybe consider that the coast is clear to come back in. And that's what Andy did in this case, knowing that it was a downgrade.
That green bar right there, I think, is when I bought it back. But it was looking over there, had some support there going back in the middle of March. But anyway, I can't remember the exact numbers, but the point I want to drive home is if you get a nice-looking chart that's having a nice little run to it, and all of a sudden it gets the pegs knocked out from underneath it by an analyst downgrade, keep an eye on it and look for that reversal probably after the second or third day, and it's very likely it's going to resume its uptrend.
Where's the stock now? Did it break out? on Monday, or is this an old chart?
Yeah. You know what? You know what? I sold it going into earnings. It did break out. It broke out, but and then it had earnings and it pulled back down to that
Okay.
16 level. It did break out, but I actually I think Valero was real. Yeah, I can't remember the reason why, but I just
So,
profits.
just to hammer one more point home, big difference, big fundamental difference between a company issuing downward guidance or issuing a warning versus somebody or some group's opinion. Big difference. Don't let that shake you out. Okay, now we're going to talk about intraday and
I'm going to
daily
hit Gary's
setups.
question right
Okay.
there. He asked how much weight do you give to the 200-day moving average in swing trades. It's a good question, Gary, because that's one area that comes into play that doesn't quite come into play that much on my day trading or our day trading. It's a 200-day moving average is a big number on a daily chart, and
And we do have a lot of them coming up.
watching that. Uh-huh.
That's becoming kind of a current question, a current issue there, Gary. The NASDAQ has been battling its 200-day. A lot of stocks have been battling them, so it's starting to come into play here, without a doubt. So what we're going to do quickly here is, Andy's going to be right back, using an intraday volume and setups. So we've looked at pretty much mostly daily charts up until now. So let's talk about how something comes onto the radar and how it might become an actual swing trade. This was a trade the other day, CPSL. And going into this, there had been a lot of small Chinese stocks, a lot of $1.50, $2 stocks that were just catching wind and taking off, ripping 30, 40% a day. And in that environment, you start to get more and more confident that there may be some more of those. And the dynamic being, there's shorts throwing in the towel. There's speculative longs coming in, looking for second and third tier stocks that haven't been picked over yet. And it's quite simply just volume coming in. It just tells the picture. Once you see a few of these things happen, in the week, you can understand that this is kind of the flavor of the current market conditions. You start to keep an eye on some of these smaller stocks as of late, and as volume comes into them, they go on the radar. So this was a trade that Andy had been watching, and this is an intraday chart of CPSL on the 5-minute. And let me get my pointer here. Essentially, he was looking at this level, and then, of course, we have a bunch of volume coming in here. Well, this got him into the trade, and then what I'm going to do is show you what the daily chart looks like. And once we looked at the daily chart, it was one of those things that he said, well, maybe this should not be just a day trade based on what's been going on in the market the last week with a lot of second and third tier stocks catching fire. This might be one to hold on to. So shifting here from a 5-minute chart to a daily chart. Here is that trade in action. This was the day right here that Andy got long. And you can see this was the first day of volume that was coming in here. Well, that particular day, as we got through, I know he was watching those levels, and we were able to close through those levels. Let's go back to here real quick and just make sure. Yeah, we even closed above those levels too. Now, we did have a bit of a wick, but it didn't. In other words, it did not close on highs. But we still got a nice follow-through because, maybe it didn't close on highs, but it did close above this breakout period back here, and most importantly, this recent breakout period with volume. So there you had momentum, and the next day, people had to pay up. And it just kind of explains itself there. There had been a lot of stocks recently that had been doing this. Had very important point. Had we been in a downtrending market and 8 solid weeks of selling, and the sellings, buyers just couldn't get anything going, I don't think you'd be taking a chance on a trade like this. But knowing the way it's been lately, knowing that second and third tier stocks have been popping like popcorn left and right, this market environment was ripe for a trade such as this. I don't know if I missed anything here. Basically, this was your day trade. You got into it based on this volume, right? You got into it right around here.
I was watching the stock. I've been eyeballing it on the daily, and seeing that volume, I bought it at 169. And
Okay.
this is a prime example for you guys who are able to watch the market all the time, and especially or if you're doing a little bit of day trading and swing trading. This is a setup where I will use volume on the intraday and a setup on the intraday to take a swing trade position. And I took a little position. This is 169 there. And as you can see, had a nice volume bar that day, closed on highs, held all of it. The next day, just a huge move on huge volume. Couldn't help but take some profits as it moved higher on that second day, because I did have a pretty good position there, and was just taking profits. And I sold the last of it at 320 on that third day. Was struggling, and that's example of, guys, if you get this, this incredible number, percentage move, and you start making 100% on a trade.
Yeah,
that's
don't
a
get
time
greedy.
where, if I ring the bell on all, on all of it, and ends up going another, 10 or 20%, that's fine. I don't care. If I now I have to look. But I think it's back down to like 250 or 230. I can't remember now, but you get that kind of move, guys. Just count your blessings.
Those don't happen very often. But the point being is they had been happening prior to this in other stocks, and so the conditions were ripe. And a lot of people say also that when you start to see these smaller, small cap stocks popping, 20, 30, 50% in a day, it starts to signal the end of a little bit of speculative action that we've had here. So some people are looking at these smaller cap stocks exploding as maybe a sign that we're getting in the later innings here of this big bear market bounce we've been having the last 8 weeks. But one more thing before we go. Again, had you been long this stock and held it, look at this. We closed on the high of the day on super duper volume. And even though that was a great setup to take it home, it still worked because the bottom of this candle was where we gapped up the next day. So you still got...
No. The top of that candle is where we gapped up today. If it's a red candle, so it means we topped.
Oh, I'm sorry. Yes,
there.
the top of that candle. Thank you, Andy.
Yeah, so you had a huge,
so
nice huge
you did get another 30 cents or so in there. And then, like we say, when you get that follow through and the gap up, at least put a stop in there, a trailing stop of, I don't know where you'd put a stop in there, but the point being is there was another example of huge volume closing on the high of the day. You can squeeze a little bit more out of it on the next open. More often than not.
Yeah.
Not a
And
guarantee.
somebody mentioned, I think it was Nick, I saw mention Crocs was another real good setup too. And it reminded me,
We'll
Nick,
look
and
at
I'll
that
show
one.
you guys
Yeah.
that. Yeah.
Remind us when we look at that Crocs here. So we're getting close to the end of the slides, and we'll get to the question and answer here. So again, we thought psychology is the most important part of this game. It's you versus yourself, kind of like an athlete, kind of like a golfer, you versus yourself. And, understanding how the mind is programmed. Again, that's what that Jesse Livermore book, Reminiscence of a Stock Operator, we get so much out of that, collective human emotion of the masses, human emotion of the individual trader, and some of the pitfalls. They're timeless. They happened 120 years ago, but the game remains the same. It's just the technology is a little bit different. And what he wrote was, I believe that uncontrolled basic emotions are the true and deadly enemy of the speculator, and that hope, fear, and greed are always present and sitting on the edge of the psyche, waiting on the sidelines and waiting to jump into the action and plow into the game. And so, just to leave you guys with some psychology edge thoughts, that book, Trading in the Zone, is geared all towards psychology, constantly recommending that book to people. And like I said earlier, trying to be aware of the herd mentality and avoiding it, the fight or fly mentality. Like I said, we're all programmed, when a gunshot goes off to jump and run for the nearest exit. We can't help it. It's just the way we are. But when you start to recognize that in trading, that you're running with the herd, you'll start to see more often than not that you're going to get chopped up and you're going to be on the wrong end. I use an example like in nature. Many times, the animals' kingdom, the penguins will run up to the edge of an iceberg, and a couple of them will jump in, and the rest of them kind of wait and see if it's safe. And if the other penguins make it to the other iceberg without being eaten first, and then they jump in. Well, sometimes they're just waiting to be eaten, whereas the ones who took the risk initially were the ones that made it to the other side. It's very hard to go against the herd mentality. You're going to want to wait for a couple of green bars to feel safe before you jump in, but in all honesty, you're probably chasing price instead of waiting for the people to get scared that just bought it and start to sell back into the hands of the people who are waiting at just a higher low, waiting to catch those shares at a better price and catch a better entry. So that's kind of what I mean by fighting the herd mentality. And then, of course, hope and fear, being constantly aware of, like Andy said, hoping that the price will not, hoping that the price will go higher on a losing trade, and consequently fearing that a good trade will go lower and selling it too soon. If you can just be aware of those instincts, it'll help you fight them.
Yeah. And some tools that will help you fight these instincts, guys, is just physically putting in stops and leaving them in there. Okay, it's hard to do. You know, a lot of times the stock will be going against you, and you'll be like, oh man, you know what? It's gonna stop me out, and wick and go higher. I know it is. I know it is. You go in there and you cancel your stop, and then next thing you're, well, I'm gonna put it down here, and it's an endless, brutal game. And just don't do it. I mean, if you take a position, find your stop, and physically set it in there, guys, and just you know, if it starts to go against you, don't revisit it. Just let it go and let.
Do not become a hoper.
No.
And do not average in.
It's easier said than done, but you have to fight. You have to fight those human instincts, and just the opposite. A way to help your winners to learn to let your winners run longer, guys. If you just take some off, just take a little bit off. That satisfies that little fear demon in you, and then let the rest run. And I can promise you, if you start, the more you do that, the more you're going to take less and less off as they run in your favor. You get in the habit, hey, this works, okay? And you basically, what you end up doing is you reprogramming the mind to stay in those winners longer and cut those losers quicker.
And you know, whatever it takes to get yourself ready for that mentality. Sometimes, you know, just a little bit of before the bell rings, maybe just kind of close your eyes and envision yourself seeing some setups that look on the surface to be dangerous, but in reality, your gut instinct as a trader knows they're right. And if you can kind of focus your mind to take advantage of those ahead of time, and you know, like I always say, chance favors the prepared mind. You know, just be aware. Just constantly be aware of yourself and how you're reacting emotionally.
Mm-hmm.
And I think that's it for the prepared stuff. So what I'll do now is I'll give Andy control of the desktop, and we can start to go into some chart patterns. And if we missed anybody's question, we'll get back to it. I did see one that I know was missed earlier by Ricardo. Have you ever heard of CY Group? You have less than 25K in your account and considering a membership with them. I've heard of them, and from what I understand, I think they have a nice compliant business model over there to bring new traders in. So I see no reason why you couldn't give them a try, Ricardo. All right, let me give Andy.
Okay.
I forgot how to do that. There we go. There's you are. And we're going to make you presenter. And he'll accept it, and we'll start looking at some live charts and fire away with some questions here.
Yeah, guys.
First one from Nick. Looks like, did you ride Crocs? Well, so we talked about going to Crocs, so we might as well start with that.
Yes, actually, Crocs was a very nice trade for me, and we'll look at Crocs here, and I'll show you what I saw. This is first off, this is the e-signal that I'm using. This down here is Trade Ideas. It's a alerting software. Would highly recommend, and these can be configured to help you find. I'm constantly watching the market, so I don't use a whole lot of alerts to help me find swing trading patterns, but they can definitely be set up to use that. If you guys want more information or you want a free trial, you can just go to our website. We have a link on there that'll give you a free trial with all the bells and whistles, and we're the only one you can get that free trial through. So anyway, just wanted to point that out. The software that I'm using, my trading platform is Ready Plus. This is my day trading platform. And getting back to that Crocs.
Why did it get hit, by the way? Let's start with why did it get hit? It was earnings, right?
Oh, right here?
Earnings, uh-huh.
Yes.
Earnings, okay.
Yes, which I sold before earnings. But you're right. That's why it got hit.
You got to be aware of when earnings are coming up, guys. Especially in earnings season, it only comes around once every 3 months. But the last thing you want to do is be in a stock. You're going to kick yourself if you did not realize and you were not paying attention that earnings came up and you did not have a plan of action before then. So always be aware of when your longs are having earnings.
Yeah, and sometimes, guys, I've got caught on the wrong side before because I'm trying to watch all my day trading stuff and to keep track of everything. It takes some work, but if you're not day trading and you have time, yeah, just first of all, you don't want to be I don't see any reason why you should be in more than 8 to 10 positions. So it's not, there's places where you can go and find out when earnings are and stuff like that. But anyway, I'm glad you brought this Crocs, Nick, there, because we didn't have it in our webinar, but this is a good example. I actually bought this thing, I believe at let's see here, pull this up. Yeah, I think it was around one. No, I wasn't that close. Let's see, right there. Yeah, I bought it at 190. Right off that moving average at 190 there in my day trading. Had some nice volume off the lows here. A lot of people will not play little pissant stocks. I've made a lot of money on them, especially when you have a bull market run like we've had. A lot of times these stocks, these forgotten stocks, will be laggers, and there will be some, and some people coming in late to the party who's missed a big run. They may try to jump on some of these little pissants, I call them. But anyway, if I see volume, I see the right chart set up, I'm not afraid of them at all. And so anyway, I bought it at 190 there. You had good volume on this move right here. Came back, it's been consolidating on that fast line, and picked it up at 190. And I didn't add to my position because I actually took a pretty big chunk right there, just because I like the setup. I knew my out was going to be if it broke down below this average. So I had a tight stop in it, and it held. And I think on this move right here, guys, I took half my position off at around 240 level. So I took half my position off. I was kind of playing with house money there. It would really have to, come in for me to have a losing trade here. So I just relaxed on that last half. Had a nice move there. I think I sold another quarter of my position, leaving me with on that big volume bar, leaving me with 25%. And I believe I took the last of it off on that day right there.
Right before earnings.
Yeah, I may have taken it. I can't remember exactly, guys, but it was a nice trade, and that's just an example, guys. Look, just like we talked about. Okay, you had your up bars. Okay, on this up move, look at the up volume, and look at this pullback here. Very little down volume. Okay, not a whole lot in this up move right here. Okay, but then boom, some more up volume. Once again, pulling back on lesser volume. Volume, 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 guys. That's what you want to focus on. That is your key indicator, and it typically doesn't lie. So, you got any more questions out there? Let's see.
I'm sorry. Yeah,
okay.
let me read the next one here. It's from John. On a pullback to the moving average or trend line, what are the most important things to decide if you should anticipate a scale in or a breakdown?
Well, one of the things I'm looking at is right there where I just mentioned. I'm looking at volume. Like you see this, just staying with this Crocs right here. Yep. You see a pullback back to the fast line there. I'm using this example, although it wasn't right here. Yeah, I'm watching that volume, and if I see the volume a lot less than what it had when it went up right there, I'm holding firm. I'm giving myself a little wiggle room. I'm not going to let a small move below that line get me out on the intraday. And that's the thing I'm looking for. Looking at. I'm watching that volume, and I'm looking at. Go ahead.
I was just going to say it's funny because I started jumping the gun on Friday. I said, Andy, this is starting to look like an interesting swing trade, and he reminded me of one of our rules is that let's let at least 2 days of air come out of the stock as the disappointed sellers react to the bad earnings or the earnings. I shouldn't say bad earnings. Let's just say it's the reaction to the earnings. Now, all of a sudden, look at this. We're back on the trend line here. But one of the reasons we didn't get in and take a position is like we said earlier, we wanted to kind of stick to our our reasoning that after a significant change like this, it's going to take a good 2 or 3 days to get the remaining sellers to cough up their shares and wash out. So here's what I'd like to see on Monday. I'd like to see a nice doji day on this Crocs. In other words, a nice narrow range day, not really going up too far, not going down too far, closing right in the middle of its range on pretty decent volume. So that tells me that it's holding that level. It's continuing to consolidate and get shake the trees and get the weak hands out, but it's also bringing in new players as well. So this one might be on the radar here for a trade. We're going to keep an eye on it. I think some things to look for here would be that 200-day moving average, that green line, and also that 20 line. I'd like to see maybe one more day of some nice consolidated action before it may think about resuming a trend, because you've got a trend line there, you've got volume. You've got a few things working. You just don't want to be the one buying it at $4.
Mm-hmm.
That's a chase. That's not being
Exactly.
patient. That's not being disciplined. That's not being patient.
Yeah. Here's a good example of an Aetna trade. This is what I'm talking about. Okay, this is Aetna. Okay, this is the day after earnings. See that big red volume bar down right there? And you know what? I wished I didn't buy this in my long term, but this is a prime example. Okay, you had a big move down, went to lows. Okay, look at the third day. Okay, you had 3 days right now where it couldn't go any lower. It couldn't go take out the body of this candle right here. Okay, that's a good level right there. Fourth day after earnings, you have a bar reversal, possibly a really good entry right there. So, okay, yeah, this is a case where you could have taken a chance, but why? You had 2 more days where it really didn't do anything, and then on that fourth day there, had a nice little move higher after earnings. Okay, here, let me see. After John, let's see. How do you find when earnings are coming out? Well, there's several sources you can go to. I use briefing.com. You can do a ticker search on briefing.com, and you can find out when the earnings are. Also,
Yahoo Finance.
Yahoo
Also.
Finance.
And Market Watch.
Although I've yet to find out where you find it on Yahoo Finance.
No, really.
But I've been using Briefing for years, so I always go there. But
And Market
I'm
Don,
sure there's a place.
Don's pointing out that Market Watch also has an economic calendar, and that's a free service. So.
Okay, thanks, Don. But yeah, keep an eye out because you want to know. You don't want to be caught in something like this. You had a stock here, earnings coming out. Look going into earnings as the market was going higher in April. Man, that kind of should have told you something right there. If you're in this trade, okay, and you're sitting there, you got in over here, and you're going into earnings, and this thing hasn't moved. And I got to sit in a small loser. I'm getting out. I can always buy it back.
Yeah, Nick, it says at briefing.com, do you get up-to-the-minute news? I would like to know if I would be informed about the dry ships being diluted on Thursday before it sold off on Friday when Google Financial picked it up. Let's look at dry ships there. And yes, to answer your question, Nick, briefing.com, you get pretty fast news, pretty fast information, and you can also look up earnings and economic things. There's a lot of research to be done on there, but we use it primarily for, our news service. We've had real-time, super fast Squawk Box news service where there's a guy talking and reading the news, so you get that split-second speed. But quite honestly, that's a bit overkill, and it's too much noise, literally and figuratively, for me. So briefing.com works well. It's relatively priced, under $50 a month, and you get real-time news. So as far as dry ships goes, what happened was it on Thursday? I don't recall if that came out on during the day on dry ships. What I can do, or actually, let's do this. Why don't you? I wonder if we could bring up briefing and then just type in dry ships and see when they announced that. What do you think about that?
Okay, you want to? Okay, let me see. That may be tough to do.
Okay.
We'll have to do a lot of dead time trying to scroll back and find that stuff like that. But
I wasn't paying attention. Why don't you talk and I'll look it up? Go ahead.
Okay. Yeah, I really didn't catch that news. I knew there was something out by the way it was acting. I actually tried to short this and wanted to short it that day, but I didn't have the shares in my brokerage account. But yeah, briefing is usually you definitely can find news on briefing. I'm quite sure that this news would have been on briefing. If they have dropped the ball a couple of times, so I'm not going to go out on a limb and say for sure it was on there, but it's more than likely that news was on briefing. It's a good source. It's reliable. Whether you need it for like just for swing trading, it's just $30 a month. It's kind of spendy for just for swing trading. But if you're doing some day trading along with that, you're doing it if you're swing trading full time, yeah, it's probably a good source. But if you're just holding down a regular job and just doing some position and short-term trading on the side, I don't know if I would cough up that kind of money. But
just to answer your question, Nick, going back here, that May 8th is the news on dry ships, which tells me that that news probably came out after the close on the 7th, and so there was really nothing you could do because the market wasn't open. If briefing had shown something during the 7th, during trading hours, but I think it looks like all of this happened after the market on Thursday, so there was really nothing you could do on Friday until it opened.
well, Yeah, and what you would do at that is you maybe wait to see how it opens there and try to run up, and then just once it rolls back over, I'd be looking to get out because the chart is pretty much is breaking down. It's hard. It's hard to say. It depends on where your entry was. I was actually long price ships at 470 my long term, and sold it a little bit too early, but they were going into earnings, made me a little bit nervous, and I just took my profits on that one.
All right, let's see here. Let me get back to my question screen. Andy, a question from Mark. Do you keep your watch list up on your trading screen? I think what you mean is during the live service. Are those what you're seeing now is what you see during the live service. This is the same screen. So those three boxes down below, the red, the green, and the one on the right, are the main tools we use for alerts. And the red is filtered for stocks going to lows and heading down on big volume, down quickly on big volume. The one in the middle is for stocks going to highs and running up. But most importantly, they're filtered for volume moves. You have to have a lot of volume, otherwise it's not going to show up in these alerts, which filters out a lot of the noise.
Yeah. And I will use those alerts, even the intraday alerts there when I see volume coming in to take positions in my long-term account. I mean, it's running up on some good volume that tells me volume doesn't lie. So
Palm was a perfect example of that.
Palm's example.
We showed
Capsule,
that chart. Yeah. We showed that chart earlier in Palm, how we saw the volume, and then when you looked at it, you go, hey, wait a minute, there's something going on here on the daily chart. This thing could have some legs, and then it becomes a swing trade or a short-term couple day trade, couple days there. You were just saying if you're swing trading, you don't necessarily need briefing.com. What news service would you recommend? I think Yahoo Finance is fine for a free news service. And somebody did just send me a link a minute ago that they do have a place where you can go and get earnings. Let's see if I can find that here.
Yeah, getting back to that Palm you were mentioning about, that was a day that it had a nice little run up there and caught that off of the alerts. Unfortunately, I didn't buy that in my long-term account. I made some money, nice money scalping it, but in my day trading.
Let me do this. This is kind of goofy, but let me do this. I'm going to send you a link, Andy, to this, and then you can just show it on your screen. And if somebody wants to maybe write down the URL, they could do that.
Okay.
This is for Yahoo. Hang on. Okay, here it comes. Just pop this up on your screen, and then people can maybe write that down, because I don't know how you exactly get to it from the main Yahoo page, but if you look at the URL up there, this will give you kind of what briefing.com does for free here on Yahoo Finance.
Okay, no, that's good.
And also I'm hearing some really good things about finviz.com. You've heard about them too, I think, haven't you?
I can't say that I have.
Let me just bring it up here.
Leave that alone. Sorry. Maybe took that down a little bit in case somebody was trying to write that down.
Okay, here it is. Let me send you this one too, real quick, because this is.
Okay.
I'm hearing a lot of good things about this site, and it's fast becoming a new good aggregated site for free, and gives you a lot of good sector strength for the day. That thing on the right is called a heat map. It basically breaks it down. You can see where the heavy green is where the money's flowing in, and the heavy red is where it's flowing out. So you just look at that chart, and you can see ExxonMobil is having a good day. The retailers down there and the banks were also pretty strong. JP Morgan, USB, real strong sector there. And then up top in the upper left, you can see tech. Got whacked pretty good. IBM, Cisco, Oracle, all red on the day. So it's a nice little graphical heat map, they call it, to give you a quick idea. And again, this is fast becoming a pretty cool aggregated free site. So there's two free sites that hopefully can help you guys out.
Oh, interesting. It does look a good site. That is real time, or is it a subscription to get real time?
No, it's as far as I know, it's
Okay.
I don't know if it's real time or not.
No.
I don't. But somebody in our service actually showed us this on Monday. Somebody was asking, "Can you put it back up?" There was an advanced decline line in there that some people like to look at. And if you're looking for a place to get advanced decline, it's underneath that Dow chart there. It's a little graphical bar chart. We finished the day with 75% advancing down. Right. There.
Okay.
Okay. That's like a little bar there showing the
interesting,
advanced
yeah.
decline line. So, the day started off really weak. I think our advancers were down like around 35%, but by the time the day finished up, the advancers totally beat out. So some good information on there.
Yeah, I like that. I'll save that and use it.
Okay.
Very informative.
Here's another question. Since stocks gap downs are a big part of swing trading, how do you choose stocks that have the least chance of gapping down? Well, we never really know when a stock's going to gap down. You never know what's going to come out of thin air. But it looks like the meat of your question is, how do you choose stocks that have the least chance of gapping down significantly? Well, there's some stocks that you probably do want to avoid that are a bit more, I would say, paying attention to lower volume stocks can get whipped around more. Stocks that only do 50 or 100,000 shares a day might have a tendency to react more exaggerated than other stocks. You have any thoughts on that? It's kind of hard because you just never really know what's gonna happen.
I'm not. I don't know. I don't really recall saying we're looking for entries in big gap downs of stock. I mean, maybe after earnings, there's something we want to watch for 3 or 4 days. But on a big gap down, I'm not necessarily looking to just buy that stock, a particular stock on a gap down. I'm looking more at a daily pattern. What's it doing after that gap down? Is it after earnings or bad news?
I wonder, are you talking more, Nick, of already being in a position and worried about a gap down, or are you talking about searching the market, looking for opportunities that gap down? And maybe a more qualified answer that way. If you're talking about being in a trade, there's really never any guarantee. You never know what's going to come out of the woodwork. So.
No. That's not a big part of my repertoire. I'm not necessarily looking for big gap downs. Typically that tells me that they're gapping down for a reason. Now, if it's stock, if I'm have it on the radar, like an Aetna or something like that, I knew it had a big gap down after earnings that day. I actually was playing this on the intraday, but I never bought it really in my. As the market gets closer and closer, and I want to talk about that before we leave today too, where we could be heading as far as this market goes. But so I'm not taking a whole lot of longs on right now.
Yeah. Just to qualify his question, it's if you're already in a position, what can you do to try and protect yourself or help, not getting the rug pulled out and getting gapped down on, which is a hard question.
Yeah. Okay. Let's just use this Aetna for example. You can see right here it gapped down. Pretty close to the lows of the day. If you happen to be in a trade like this, it gaps down, okay, more than likely that wick occurred. Well, I have to go too far back on my intraday. More than likely that wick on the bottom there occurred pretty close in the opening of the day. A lot of times you'll have opened up right here, went lower, and then popped up pretty quick. No, I take that back. That's right. It opened up right there. But if you were in this trade and you happen to sit through that, and I'm looking at the next day. If it ever goes back and takes out those lows, I'm getting out. If it takes out the low of the days after earnings. If you happen to be in a stock that gaps down on you, and you can stick it out through that first day, the days after that, you want to watch and make sure that stock holds that low where it had that big volume, or more than likely that thing is going to go lower. So I think that probably answers your question there. I'm trying to think of well, I'll tell you a prime example, guys, and this is one that I was actually in, and I was in at 15, but luckily I just took 1/3 of my position at 15 in the Stewart title. I made some decent money on the Stewart title, my long-term account, I was fortunate enough to catch right here, the bottom of this right here, where sold off, lesser volume, and all of a sudden you had a wick and closed near highs. Okay, watch that. When it took out this high going back over here, I started accumulating it, and this is a trade that you know, I bought some more as it went higher and ended up selling up here once it reversed past this fast line. But the point I wanted to make, I was in this thing right here, okay, caught me a little bit off guard. Like I said, you know, I make mistakes too. Got caught in earnings. Well, why don't you look what happened the day after earnings? Very, very bad earnings. And, you know, I held on this day because I only had 1/3 of my position, very small position, okay, and yeah, that went against me. And this day right here went lower, put in a wick, and then went higher. This is just a case of I kind of knew a little bit about this company. Not too many companies I know about, but I knew a little bit about this one, and you know, I held on because I had a real small position. I was able to sit through. I'm not recommending doing this, but this is a case where you know, I watched the action 2 or 3. Yeah, it's a very tough one. It's a very tough one to hold on to. I don't recommend it, but this one I just I knew a little bit about the company.
Yeah, I could easily see.
I ended up selling the other day at 23.
I could easily see getting stopped out and shaken out of that.
Yes,
one. But I think
that's
the point being is Andy's very familiar with this company. He's very familiar. So
yeah, but that was a case where you know, that's an unusual circumstance right there, and in all likelihood, you know, I should have been stopped out of that one. I hate to say that I broke my rules a little bit, but this is a company where I had a real strong feeling that that earnings report was just an anomaly, and
yeah.
But anyway, I don't know too much about fundamentals, but I did know a little bit about that company. So
There's a question on volume from Mark. Would you guys recommend, say, using a 20-day moving average overlay on the volume or not? I've never been one to use an average because I think if you just eyeball the volume bars, you can kind of see what's relative, what's good volume relative to prior volume. I've never used an average overlay on my volume charts. It's not to say it might not be a bad thing, because I just want to remind people that trading is very subjective. It's an art form. You know, I'm not a math guy. I'm more of an art guy and more creative, and I see the market from kind of a different pair of glasses that other people might see it. If you are able to use an indicator and over time notice some observations that seem to give you a bit of an edge, by all means use it. But for our intents and purposes, I just eyeball the volume candles and just get a feel for it that way, Mark.
Okay. Did we answer John's question there? Because I think he asked it a couple of times. When you enter a trade intraday, do you set the stop on intraday or daily?
No, we need to elaborate on that. Yeah.
Yeah, I always set the stop on a daily chart. I'm not looking. And guys, you got to remember, I'm always here watching the market. So if I'm taking a position with a small position, like a third of my position, I have to admit that I physically don't go in and set stops a lot of times because I know it's a very small position, and I'm able to watch it all the time. So and keep up with it. Unfortunately, a lot of you guys aren't going to have the same benefits that I do, being able to watch it all the time. But if I am setting a stop, guys, I'm setting it on the daily. For example, I just entered this FNF on Friday.
Good one to bring up. Yeah.
Yeah. This is one I just entered on Friday at 15:30, and They just had earnings. Okay. They just had earnings. We're into the I think the second day after earnings. Okay. I got this 200-day moving average right here. Okay. You got the low of this bar is at, well, let's just use the 200-day. Where is it at? 1491. Okay. So I just entered a third of my position. Okay, now I will give this thing a wiggle room. There's a good chance that this thing is going to try to break down below this 200-day moving average, possibly go test these lows over here. I'm not saying it's going to, but there's a good chance it's going to happen.
You're preparing for it, yeah.
Yes, I'm preparing for it, and that's why I only took a third of my position. This is a stock that not too long ago just hit a 52-week high. Now, what I don't like about this pattern is you have a stock that's bleeding off as the market goes higher. That's not a good sign, okay? But this is another title company, much like Stewart Title, and this is just one that's been getting hit pretty hard, I'm taking a chance down here. I'm doing a small size, and I'm able to watch it so I can keep it on the radar. But if I was taking a third of my position, probably what I would do is looking at that 14 hole number. You know, I probably don't want it to go below that 14. And if it goes, you know, if it goes below that 14 and it closes below that 14, you know, I'm probably out. Now, if it wicks down below that 14 and pops up above, you know, I'll stay in only because I have only a third of my position. Okay, I can take those kind of losses because if you're able to let your winners run, guys, you'll learn to stay in a lot of these shakeouts and not get stopped out of things so easily. So you take small size, you give yourself a little wiggle room below that 200-day, possibly below this low over here at 1420. So there's a good chance if this thing closes below that 14, I'll be out.
Just to get back to the gap thing again, you know, Nick says he's seen stocks gap down He's seen stops gap down 17%, and you know, overnight, and yeah, that does happen. There's really nothing you can do to prevent, you know, a gap against you. I think that's what Nick's trying to figure out, is how to really try and maximize his risk, manage his risk when the prospect for gaps are always out there and you're holding stocks overnight. And that is one of the inherent risks, Nick, of holding overnight. And you know, if Andy has any more thoughts on how to protect against gaps, we can discuss it. But other than that, it's just one of those inherent risks.
Yeah, it is. It is. I mean, you're gonna. Let's go back to this F and F chart and use it for an example here. You know, there's a good chance. You know, they did have earnings was out, so I'm not worried too much about earnings now. So you know, as some other news comes out and this thing gaps down below this 14, yeah, I'm gonna have to watch it closely. You know, I don't want it to close below that 14 level. If it goes down and wicks and pops back up, you know, I feel pretty good about it. But at the same time, you know. You know, if it's a tough one.
Here's I could
you
say
have
this.
to protect yourself against gapping down and going lower, but
yes,
but
what you want to do is pay attention to, okay, the stock gap down and you're long. Okay, you can't control that. Now all you can do is try and manage the information you have in real time. Like Andy says, if it gaps down and starts trading lower, you want to just get out. If it gaps down and catches a bid and starts to trade back up, well, then maybe you might want to start redefining your loss. And the important thing is paying attention to how it trades after it opens, I guess.
right, yes,
But again, it's a tough answer to give you, Nick, because there really is no thing that you can do to protect against them. All you can do is try to manage them once they do wind up opening up. And if there's continued pent-up demand to sell it, it continues to run to low, get out and just, you know, take your hickey, take your bruise. But if it digs in, volume comes in and starts to trend back up right after the bell rings, well, then start looking at the levels of prior support for that morning and try and maximize or minimize your losses if you need to. But there's just nothing you can do to protect against gaps. There's no stock that's going to be more likely to gap than another stock. It just kind of depends on what's priced into that particular stock at the moment.
yep.
Let's see, a couple more questions here. Let's see, the first one, okay, looking at UNG, it appears the next level of resistance is 18. That last close was higher. It wicked down but closed higher. Volume is increasing, but you stated that you would not buy here. It seems to me that this stock has another buck to run.
Well, that's a good question. Who was it, Ed?
Mark.
Mark. Good question, Mark. You know what? It is enticing, and it does have more to run. Okay. Now, I don't like to chase. Okay, but this is definitely not. You take a look at. Which I wanted to do this anyway. I wanted to do the weekly on this and show you guys what I saw. Okay, this is what I saw on the weekly going back, and
There you go.
Yeah, this is what I actually saw the volume coming in on the weekly, actually on the intraday. So I kind of entered my position early. But then at the end of this week right here, first let's go back to this green bar over here, guys. This is what I'm talking about. You had a nice little volume green bar for the week, but look at that big tail it put in right there. Right there.
I would have taken
Okay.
that entry, but then you had to manage it.
Well, here's the thing. Yeah, you may have taken it. You may have taken it on the intraday, but if you go back and look at this candle, you had a big wick there. This is okay. So it finished barely finished positive on the week with a big old wick. Okay, so that's now look at that compared to right over here where I entered. You had a weekly pattern where it finished about the same amount of volume going back over here, and it closed on the high of the week. So those are the kind of things you want to. Steve's real good about. Candlestick charting on the daily, and he's taught me a lot. And there's a lot of times I use these multi-time frames. So I like to look at dailies. I look at weekly patterns. Sometimes even monthly. But I may be kind of getting off the question here, and I want to go back to Mark's question. So what you could do in an example like this, because this is a nice volume, nice momentum, and if you look at the weekly there, like I just showed you, okay, it doesn't look like it moved a whole lot, but it has made it make a pretty big percentage move. So I would probably be looking more for a pullback. Now, if you felt like you wanted to take a position in this, what I would do is take a small size. I would take, may want to watch it. It's a good chance this thing's going to go up here to this level right here. So if I was going to take a position right here, this may be one of those circumstances where I only take like a fifth of my position. Maybe if I want to buy 500 shares, I'll buy 100 shares.
Just enough to put it on the radar is what we always say.
Put it on the radar, exactly. Then if it pulls back, this is an instance where you can scale in as it moves against you. Okay, I don't think there's anything wrong with that, guys, as long as you define your loss. And if it pulls back to that 15, you watch it stabilize, then you may buy another 100 shares. I don't think there's anything wrong with, I'm not going to call it averaging down, but because you're actually scaling into your position by using very, very small size, 1/5. Yeah, this may be a case where I'd only buy 1/5 instead of 1/3. Because you're right, Mark. I mean, the pattern, and I feel it has a lot more to go too. And if you feel like you're going to miss it, but to just go in right now and just
I'll say this.
I
say this a lot.
Risky.
I say we have a pretty good feeling that it wants to go there. We just don't know what road it's going to take. Is it going to take the express road, or is it going to take the mountain scenic route? And
right.
You can get, if you jump in thinking you're going to take the express road, sometimes it'll take the scenic route and shake you out. So you can buy a little bit, and if you're wrong, you can because buying a little bit, not a full position, puts on the radar. You can work the position and develop a position on pullbacks. Mm-hmm. We're going to probably wrap it up here in about 6 or 7 more minutes, so we'll have a few more questions we can get to.
Okay.
Ed stepped away, but he had a question, and I saw it earlier, so it's the second time he's asked it. We want to answer it. Trailing stops, do you use them, and if so, how do you decide on how to trail the amount or where to trail the amount?
Very good question, Ed. I actually don't. I will use, like I said, I'm able to watch it every day, so I'm able to be on top of it and watch my positions and just go in and sell. But I'm trying to use an example here. Let's just take a look at the spiders here. Okay, spiders have had a nice move. Say you're long these spiders, got into the good spot here, moving higher. I kind of wanted to show this anyway because this is a trend line that I drew back several months ago, going back to the May high right there, where we had a wick. And anyway, that's a little trend line here, and it corresponds very closely to the 200-day moving average. So we could be running into some resistance right there. But getting back to your questions, you know what? You could use, there's several things you can use on a trailing stops. You can use what we call bar reversals. And what a bar reversal is, guys, is when the high, when the low of the current bar you're in takes out the low of the previous prior bar.
So in other words, you want higher lows on each candle all the way up.
Mm-hmm. Now, I will say by using that method, you're going to get stopped out pretty quick in most of your trades. That's more of a method we use in momentum trading on an intraday. Okay, so what you could use now, I mean, looking at this daily, the momentum line here, you can see several times it's gone through this fast line. Looks like it's holding the 20 pretty good. So if you're long this stock, you might want to give it the 20 because it looks like it's holding the 20. So you can use moving averages, you can use trend lines, there's several things you can use as trailing stops.
Support,
as your stock
resistance.
goes higher. Supports, resistance. Looks like this 90 is a pretty good level here in the spiders.
So if it broke
So there's-
90, you might want to get out.
That's right. So there's several things you can use as far as trailing stops, and that's just going to be, whatever floats your boat. But I'm not going to say which is better than the other, but it's important, I think, to use them because if you have profits, you want to take them, especially if the market turns and starts going against you on volume. Watch volume.
Well, speaking of
Look at
volume, and Nick's question is, where do you find out about how many shares a day a stock average volume does? I assume what he wants to know is how do you gauge what the average daily volume is for a particular stock? For me, it's real simple. Just pull up any stock chart there, and you go to the daily chart, and you can see, like in this case, the Standard & Poor's, the high end of that range is 500 million shares a day, and you can just kind of see it looks like it averages around, I think it has an average in there, doesn't it? Is that? No, that's the prior day. So it looks like the average is around 300 to 350 million. So I kind of eyeball it, Nick, and I'm sure there's a company out there somewhere that aggregates that information and tells you what the exact number is. I don't use that. I mean, a lot of the stuff we do, Nick, is in real time, and so I try and cut corners and keep it as simple as possible. And just for me, it's a graphical illustration there, an eyeball. Look at any chart. Throw up real networks. Throw up TiVo. We look at that all the time. It's been doing some interesting volume. Normally, it only does about 600,000 or 700,000 shares, but look at this. Lately, it's been increasing in volume. And you know it, TiVo is reporting earnings here in 2 weeks. Kind of been watching this. It's breaking out of some upside resistance on volume, and we still have earnings 2 weeks away. So I'm kind of thinking, maybe somebody's thinking or knowing that this stock's going to have pretty good earnings. They're putting on a position or adding to their position. And if earnings come out pretty decent in 2 weeks, these people that are accumulating these levels right now might be looking to turn around and sell.
Exactly.
So,
and also, just a simple answer to your question too is if you go plug in any stock in Yahoo Finance, and on the front page there it shows you. Let me just go over here and show you where you can find that real quick. And right there, the volume, right there, that's the volume it did today, and there's your average volume.
There you go.
That's a 3-month average. So, yeah, I'll pull that up a lot of times too. Just when I'm looking at stocks, I look to see, well, it did quite a bit more volume than it did on the average there. So a tool you can use.
Let's see, I think there's one question here we haven't gotten to still. Would it make it safer trade to enter above the 10-day moving average? Well, for me, Leo, I try and keep it pretty simple. On any daily chart, I use the 10 period to see who's in control. Looking at this TiVo chart without changing it here, the TiVo chart is being supported. In other words, the yellow line is below the current candles, so the bulls have control of this chart right now. So traditionally, I like to be entering stocks to the long side where the moving average is supporting the price, not oppressing the price from above.
Yeah, that's
it's not the end all.
We don't want to just use 10 moving average because a lot of people use 20. There's 50. There's so many things you can use to where you want to enter a stock. A lot of times I like to take a chance on some of these ones, like an F&F. Nothing looks good to me right there, but I know there's been the sellers that have been just killing this thing and sitting in a lot of pain. That's a very risky entry right there, but it's a spot where it's extremely oversold, and I will take a chance on a small size scale in. That doesn't necessarily mean I take all my positions like that because majority of my positions, I would have to say they're above the 10-period moving average. Like a Crocs, like a pattern like that. I just like that palm we showed earlier, where stock has gone and pulled back to that moving average. The key is, don't chase, be patient, wait for your entries. But that's a good question, because if you get pullbacks like that to those fast lines, they're good entries typically.
All right, let's take one more question, and then I had a thought to finish up on. It's from Mark. It seems sometimes that you are using ETFs more as momentum indicators rather than trading vehicles. Is this correct? You understand that?
You're using ETFs more as momentum indicators. I think I do understand that. I mean, I would use ETFs. I would look at a FAST or something like that. Looking for volume. I mean, look right here on this FAST right here on this pullback here, and this is the case. You talk about shakeouts. I mean, look at that FAST gap down that day, right here. I mean, think about all the people that got shook out of this thing, and look at the volume that came in, and came in. It's been since that low, just been moving higher. I'll do that, Mark, sometimes.
We definitely key, Mark, and I know we call out a lot during the first 10 minutes of the bell each day. We try and really focus from the top down. What's the market doing? What's the S&Ps doing? And then more importantly, which ETFs, i.e., which sectors are jockeying for position early on as the money starts to come in and gets put to work that day. Every day it's money is chasing something different. Money's going in, money's coming out, and we're using those ETFs to look at the market from a top-down perspective, and then maybe try and find some stocks that are looking good inside that sector, or even just trading the ETF itself. It depends. The SLX is a steel ETF, but it doesn't have a whole lot of volume, so we have to trade the components in that ETF, whereas the XHB is actually a pretty good liquid ETF for the home builders. So if you want to just trade the home builders together, you don't have to pick one. You can trade the XHB because there's enough liquidity in there to trade as well. I'm sorry. Let's see.
I'll hit Nick's real quick. You know what? And then we'll finishing thoughts here.
Yep.
You know what, Nick? There's so many things out there to trade with all our alerts. The sector. There's. Why do I want to trade the spiders? When I have like the OHI, really strong that day or something like that and moving. And I look for relative strength and weakness, and I'm going to be looking for alerts in strong sectors versus just trading the spies. I mean, I have traded them in the past, but for the most part, I like to look for the, what's hot, what's hot that day.
Now, that's not to say if we see a great setup in the spiders, I'll tell Andy many times, hey, look at the SSO. If I feel strongly about this trade, why jump into the spiders when you can jump into SSO? It's going to give you double the move of the spiders. So if we see a nice setup in the general market, we will trade the spiders using the SSO, a double, to try and get a little bit more bang for the buck.
Exactly.
Now, what I wanted to end on was, we looked at a lot of long setups here today. Look at the spiders. That's pretty much what this market's been digesting for the last 2 months. Now, we may run up here to these that trend line and that 200-day that Andy, I think, very well put out, and we could see some trouble here. Now, if we start to roll over and the pattern in the market, two days in a row starts to be that every rally is met with volume selling, and everything that we've talked about here may need to be flipped upside down and start to the same setups, the same technicals, the same thing goes for the upside down market when shorting. So we'll leave that up to you guys to try and take the same some concepts we took, but you got to flip it upside down, because what I don't want to see happen is if the market starts to get weak again here in the coming weeks, you have to recognize that you got to trade the market first. A lot of these setups that we've seen in some of these stocks are not going to work because the general current of the market is now flowing with the sellers again. So what we've just talked about is what's been working for the last couple of months. I just want people to be aware that the market's ever changing, and what strategies worked well for a couple of months can very easily turn around and start to hurt you again. So be aware of that. We focused on a lot of long trades today, but try and in your mind flip some of these plays and setups and technicals upside down, and the same applies for the short side for the most part.
And also beware, guys, because we've had a huge move right now, and this is something I've been talking about earlier. I think I did a YouTube video, earlier in the year when I said, I don't think right in this area right here, I don't think we found the bottom, because look at this downside volume, guys, right here. This downside volume. Look at the up moves. Downside volume.
And let's look at the up move here.
And now, this is a weekly chart, and typically on market bottoms, I'm not saying we're going to go to lows, but I think there's a good chance we could possibly test those lows at some point, because still not seeing the upside volume.
We did a YouTube video about a week ago that basically talked about historically bear market turnarounds. They need to be led with volume, and in this case, this is actually one of the more paper tigers or movie set type veneer, whatever you want to use as an adjective, there might not be a whole lot of meat behind this move when you look at the internals, that the volume is just not there to tip the scales of the volume that came in on the downside. So that's a little suspect. That's keeping us cautious. We're getting close to this trend line here, so be very aware, guys. What you don't want to do is start banging your head on the long side when the market's starting to get dominated by the selling again. So be aware of the general market conditions and base your trades off of that.
Mm-hmm. And one last thing there, only how UNG may be affected by the market pullback. It's a very good question, and I'll let the internals at UNG to answer that for me. And as long as I see it going higher and pulling back on less volume, this is definitely a commodity that's laid out of the blocks right here. So that's definitely, I've been asking myself that, what happens if we get a major pullback in the market and the oil falls over? I'm gonna have to watch it. So I will let the price action dictate.
Mm-hmm.
So good
All right,
question,
guys.
All right, guys.
That was fun. But
yeah, that was
it's been
fun.
over 3 hours, and I think it's time to get on with our weekend now.
Yeah, time to get some breakfast. And
just so you guys know, you will all have access to this, of course. If you missed any of it or you want to download it and keep it on your laptop or whatever, it'll take me a half a day to process it and compress it. And I will send out a link to all of you letting you know where to download this, and it's yours to use. So appreciate you all, spending some time with us on Saturday. You could have just watched the replay, but it's nice to have people come in here live and interact, and we appreciate that.
Yeah, it really is. Yeah. We thank you, and thank you for your support, guys. And I hope you learned something today. And have a great weekend.
We'll see you around. Bye.
Bye-bye.